Hello warriors, hope you're all doing amazing. Welcome to part 3 of Costing Marathon Revision. We are here to revise the entire costing in 6 hours to help you crack your CA Inter costing examination. We've already uploaded first 2 parts of the video wherein we have revised 10 chapters of CA Inter costing in roughly 4 hours. We are here with the part 3 of the video. We have last 5 chapters pending. We have cost sheet, cost accounting system, standard costing, marginal costing, budgetary control. 5 important chapters which cover approximately 40 marks will be revised thoroughly from an exam perspective in the next 2 hours. I'm Tabish Hassan, a chartered accountant by profession and a teacher by passion. I've secured an All India rank 10 in CA final examination. I've scored 89 marks in CA Inter costing and 77 in CA final costing. I've represented ICAI at various international conferences. I'm also costing faculty at ICAI. So, are we ready to begin the chapter? Yes, students, how's the Josh? Should we start with our revision? Final 5 chapters. Everybody is ready? So, let's begin with the chapter cost sheet. Every chapter we link it to the world of costing. So let's try to revise it one final time. So costing is a systematic process of ascertaining cost. Then we've looked at the elements of cost. We have direct material, direct labor, direct expense, and overheads. Now, costing can be done for existing goods or services. It can be done for new goods or services. For existing goods or services, we have 2 objectives. One is to calculate the cost, that is cost ascertainment. One more is to reduce the cost, that is cost control. For cost ascertainment, we have the different methods of cost. We have job costing, contract costing, service costing, process costing, batch costing, output costing. For cost control, we have standard costing and budgetary control. And for decision making, we have marginal costing. Furthermore, the elements of cost, all the elements of cost put in a tabular format. We put it in a tabular format so that we can calculate what is the total cost. Against that, compare the total cost with the revenue, we get the profit. This is called as cost sheet. Again, to get all details of cost, to know what is the material cost incurred, what is the labor cost incurred, we have to record the details of cost, which is cost accounting. So all chapters of costing clubbed in this master chart. Now we are going to start the chapter cost sheet. So cost sheet, one of the most important chapters from the exam perspective. Every attempt we have a 10-mark question from cost sheet. So undoubtedly one of the most important chapter from an exam perspective. Every attempt we have a 10-mark question. So we'll have a look at this chapter very beautifully. What is cost sheet? All the elements of cost, direct material, direct labor, direct expense, even the overheads, factory overheads, administration overheads, selling and distribution overheads. All these elements of cost are put in a tabular way, so that we can calculate what is the total cost. We calculate what is the total cost, as against that compare what is the sales, we get the profit or loss. This detailed statement showing individually the breakup of cost and the build-up, the total of these costs is called as cost sheet. So what is a sample cost sheet? How does a sample cost sheet look like? Firstly, we've taken the direct material, then we've added direct labor, direct expense, we've got the prime cost. For the prime cost, we've added factory overheads, administration overheads, selling and distribution overheads. We get the total cost. That is also called as the cost of sales. For the cost of sales, if we add profit, we will arrive at sales. This is simple cost sheet. Now we are going to have a look at the comprehensive cost sheet. Master cost sheet having all adjustments. A small secret. Most of the people will try by hearting cost sheet. Please don't try that. You will end up in trouble. It is very difficult to by heart things. Instead, understand what is the logic behind it. We will be in a position to create every item automatically. So before going to the comprehensive cost sheet, let us try to understand the 3 functions of an organization and the 3 types of stock. Suppose I want to manufacture a jeans. So what all could be the 3 functions of an organization? I've started my company DG Jeans Manufacturers. What all could be the 3 functions? The first function is factory. production. We want to produce genes. That's the first function. That is the first place where cost is incurred, to produce the goods or services. Next is administration, office. To administer the entire activities, we will be incurring the cost. Third function, goods are produced, goods has to be sold. For selling and distribution, for marketing, will be incurring the cost. So three functions of any organization: production, administration, selling and distribution. Now, the three type of stocks. If we are a jeans manufacturing company, we may be having the stock of raw material, the fabric using which we are going to manufacture the jeans. So we'll be having the stock of raw material. Next, we'll be having the stock of work in progress. We have cut the jeans, we have cut the fabric, but finished jeans is not manufactured. They are still in process. We have cut them, but stitching is not done. We have stock of work in progress. Then we have the stock of finished goods. So three different type of stocks. Where will stock of raw material be there? It will be lying in the stores. Every big organization will be having something called as stores. So as soon as we purchase the goods, all the goods come and will be stored in the stores. So stock of raw material will be lying in the stores. From stores, goods are issued to factory for production. Now goods are in the factory. They are in the work in progress state. Goods are not yet finished. So goods from stores, we have issued it to the factory. In factory, production is happening. Goods are still in work in progress state. So goods will be lying in the factory. Once goods are produced, they are finished goods. They will be lying in the warehouse. So we have looked at the three functions of an organization. We've also looked at the three different stocks. So cost will be incurred in the factory, that is for production, in the office for administration, and for marketing, that is selling and distribution. Now let's quickly try to decode the comprehensive cost sheet, what every item is trying to tell us. If we are adding it, why are we adding it? Yes, we are manufacturing jeans. To manufacture jeans, what all we want? Basically, we want the cloth, that is direct material. Merely cloth is not sufficient. We want tailor to cut it, stitch it, make it into jeans. Direct labor cost. If there is any direct expense, say royalty, so direct expense will also be incurred. So direct material, direct labor, direct expense, we've got the prime cost. Yes, where all these things are happening, all things are happening in the factory. We may be having a supervisor to whom cost may be incurred. We may be paying rent, electricity, all these factory overheads. So we've added factory overheads, we get the factory cost, the cost we are incurring in the factory. But wait, this is not the total factory cost. This is the gross factory cost. Yes. From gross factory cost, we have to do stock adjustments to arrive at net factory cost. We have to add opening stock of work in progress, less closing stock of work in progress. Now, why should we add? Why should we reduce? Let us try to understand things in a logical way. So, gross factory cost, from gross factory cost to net factory cost. What is our ultimate objective? Yes, we want to calculate what is the cost for the goods which are sold. Suppose 1,000 jeans are sold in the period. So we have sales of 1,000 jeans. As against that, we want what is the cost of 1,000 jeans. So we will get what is the profit by selling 1,000 jeans. So ultimately, we want the cost for the goods which are sold. But directly, we will not be getting the cost for the goods sold. Before that, we'll try to calculate, okay, what is the cost for the goods produced? Yes. First, we've calculated what is the cost for the goods produced. Then we make the stock adjustment. We'll be getting what is the cost for the goods sold. Yes. Directly, we'll not be getting the cost for the goods produced. First, we'll be getting what is the cost incurred in the period. Yes. First, we'll be getting cost incurred in the period. From that, we have to make some adjustments. We'll be arriving at what is the cost for the goods produced. From that, again, some adjustments, we'll be arriving at the cost for the goods sold. Now, gross factory cost, it is the factory cost. It is the cost which is incurred in the factory, but it is the cost which is incurred for this period. See, what is it we are trying to tell? Direct material. In this period, how much direct material was issued? Direct labor. In this period, how much direct labor was issued? Direct expense. In this period, how much direct expense was incurred? Factory overheads. In this period, how much factory overheads was incurred? Yes, so we get the gross factory cost. Yes, so from gross factory cost, when we are going to net factory cost, Gross factory cost is the factory cost which is incurred in the factory. But for this period, for this 1 year, what is net factory cost? It is also the cost incurred in the factory. What is the cost we are incurring in the factory? But it is for the goods produced. Let's understand what is the difference. Suppose in this period, 1000 meters of cloth is issued for production. So in direct material cost, we are showing 1000 meters. Direct material is 1000 meters in the cost. But what happened? In this 100 meter is lying as closing work in progress. For 100 meter, we have cut the cloth, but jeans are not manufactured. So in direct material, when we are preparing cost sheet, in the direct material column, we are showing direct material 1000 meter. Yes, but what is the goods produced? Goods produced are only of 900. 1000 is issued, but only 900 is produced. 100 is still lying as closing work in progress. What we want? We want to calculate the cost for the goods produced. These 100 are still lying as closing work in progress. They are not produced. So from the cost, we will reduce them. Direct material, we have shown 1000. We are telling, okay, 1000 is incurred in the period, out of which 100 is not yet produced. It is lying as closing WAP. So we will reduce the cost of closing work in progress. So if we have closing work in progress, we will reduce it. Now, if we have opening work in progress, suppose in this period, 1000 meter is issued to production. In the direct material, we have shown 1000. Yes, but what happened? At the start of the period, we had 200 meters as opening WIP. So what happened? All in all, how many goods are produced? 200 was already lying in the factory as opening WIP. From that also jeans are produced. Extra 1000 is issued in this period. From that also jeans are produced. Total from 1200 meters jeans are produced. So goods produced is from 1200 meters, but direct material we are showing is only of 1000 meters. So what we will be doing? We will add the cost of opening work in progress. So if we have opening work in progress, we will add the cost of opening work in progress. That is why we will add opening work in progress, less closing work in progress. We will arrive at the net factory cost. Gross factory cost, it is the factory cost for the period. For that, we add opening stock of work in progress, because even though it is not incurred in the period, goods are produced. So we add. We reduce the closing stock of work in progress. Even though it is incurred in the period, goods are not produced. So we arrive at the net factory cost. What is the net factory cost? It is the cost which is incurred in the factory for the goods produced. Clear? Now, going further, we have told cost may be incurred in 3 places. Either it may be incurred in factory or in office or for selling and distribution. Now, in the factory, all the costs we have added. Now we are going to the next area. We are looking what all costs are incurred in the office. In office, the cost incurred, few cost may be incurred for production and few cost may be incurred for the general administration. Yes, we've shown what is the cost incurred in the factory. Now we want to see what is the total cost incurred for production. Outside the factory also, in office, some cost may be incurred for production. That we are going to add. What are all those costs? There is a specific list of 5 items. One is quality control cost, research and development cost, administration cost for production, credit for recoveries, and cost of primary packing. How do we remember it? Yes, we have a shortcut QRACP. These 5 items has to be remembered in the exact same sequence. We've calculated the net factory cost. From net factory cost, some other costs are also incurred for producing the goods, but outside the factory. What are they? QRACP. A mnemonic, if you want to make it, it will be like QRACP. QR in Hindi, we tell QRA, ACP. Yes, we have that ACP, police. Yes. So one of my friend, he was acting like an ACP, like a police. So I'm asking, QRA, ACP hai kya tu? Yes. QRA, what man? ACP hai kya? You're acting like ACP. Are you an ACP? So what are they? Q are ACP. Q, quality control cost. R, research and development cost. A, administration cost for production. C, credit for recoveries. And P is the primary packing. Yes. Now, we've added the cost incurred in the factory. In addition to that, quality control. We want to ensure the jeans we are manufacturing is of correct quality. So in office, we have a separate department wherein we are checking the quality of the fabrics. Cost incurred for production, but outside the factory. Q. Research and development. We are trying to build a new brand of jeans for which we are doing some research. This cost is incurred so that we can produce new brand of jeans, but it is incurred in office. Yes, again, research and development. Next, administration cost specifically for production. Suppose we have a production manager who will be there sometimes in factory, sometimes in the office. He'll be there in the office, but this cost is incurred for producing the goods so that goods are produced properly. He prepares production plan, factory plan, everything. He looks at all the supervisors who are there. So this is also incurred specifically for production. Next, credit for recoveries. So these three are the costs, they will be added. Credit for recoveries. Suppose during quality control, some material were not proper. So what we do? We sell it. We sell it to scrap. Or few finished goods, few jeans which are manufactured, they are not of proper quality. So we sell it as second sales. So what we do? From our cost, we are recovering some amount by selling this. We will reduce this from the cost. We reduce this. And next, primary packing. If you are doing any primary packing, whatever is the cost. Yes, primary packing is essential to produce the goods. Yes, say we have a dairy milk. On the dairy milk, we have the golden foil. Primary packing, it is essential. Without that, dairy milk cannot be produced. We have 4 or 5 dairy milk, everything will become one. Yes, things will melt and will go off. It will lose its shape. So this is essential primary packing. So that is also incurred for producing the goods. So this cost will also be added. So we've arrived at net factory cost. We are adding these 5 costs. We get the cost of production. Now we are telling this is the cost we are incurring for producing the goods. So we've arrived at net factory cost. Then we have 5 costs. Q, quality control cost. R, research and development cost. A, administration cost, but specifically for production, less credit for recoveries, add the cost of primary packing. Now we will tell, okay, now we got the cost of production. Okay. To produce the goods in factory, we've incurred certain cost, and outside the factory also we've incurred certain cost. We've added this, we've arrived at the cost of production. Yes, now we've produced the goods. Now from cost of production, we are going to cost of goods sold. Again, look at the order. Ultimately, we want what is the cost for the goods sold. Before that, we calculate what is the cost for the goods produced. Before that, we calculate what is the cost for the period. Now we have got what is the cost for the goods produced. How? See. We've got the net factory cost. What is the net factory cost? It is the cost which is incurred in the factory for the goods produced. Then we have these 5 special costs, QRACP. They are also incurred for the goods produced. So we arrive at the cost of production. What is this? This is the production cost. Cost which is incurring for producing the goods. This is for the goods produced. We want to tell, we don't want for the goods produced. We want for the goods sold, because ultimately sales is for the unit sold. So from cost of production, we'll be going to the cost of goods sold. Look at this. Cost of production is the production cost. What is the cost incurred for producing? But this is for the goods produced. You produce 1,000 goods. For producing that, what is the cost? Here we are telling, okay, it is the cost of production. Yes, to produce the jeans, but it is for the goods sold. You've sold only 800 jeans. So for these 800 jeans, what is the cost? Suppose 1,000 jeans are produced in a period. 1,000 jeans are produced, out of which 100 jeans are lying as closing stock of finished goods. So how many jeans are sold? Only 900 jeans are sold. We want the cost only for 900 jeans. So cost of production we are having for 1,000 jeans. From that we will reduce the closing stock of finished goods. So we will reduce closing stock of finished goods, because even though they are produced, they are not sold. Next, We have opening stock of finished goods. 1000 jeans are produced in the period. We already had 200 jeans as opening stock. All units are sold. There is no closing stock at all. So 1200 jeans are also sold. Cost of production, we have it only for 1000 jeans, but we want the cost for 1200 jeans. We say, okay, 1000 jeans, this is the cost. Extra, we have already had opening stock of finished goods of 200 jeans. For that, this is the cost. We get the total cost for the jeans sold. Whenever we have opening stock of finished goods, we will have to add the opening stock of finished goods. Clear? Yes. So we have arrived at the cost of production. This is the production cost for the goods produced. Add opening stock of finished goods less closing stock of finished goods. We will arrive at the cost of goods sold. This is also the production cost, but this is for the goods sold. Again, let us see what all costs are pending. Yes. We've told all in all cost can be incurred in 3 places: in factory, in office, for selling and distribution. Factory, all cost we have included. For production, in office, all cost we have included. Administration cost, administration overheads we have not yet added. So that will be added. Selling and distribution cost is not yet added. So this will be added. We will get the total cost. So we've arrived at the cost of goods sold. From there, we will add the administrative overheads, selling and distributive overheads. We get the total cost. That is the cost of sales. For that, we add the profit. We arrive at sales. Clear? This is the comprehensive cost sheet. In the little time, I've tried to make every point, explain it to you in the most logical. Yes, let us revise it one more time for me. Come on, students. Yes, firstly, we have the direct material, direct labor, direct expense. We get the prime cost. For prime cost, we add the factory overheads. We get the gross factory cost. Then we add opening stock of work in progress. Why? Because the cost is not incurred in the period, but goods are produced. So we add the cost. Reduce closing stock of work in progress. Even though cost is incurred, goods are not produced. So we reduce. We arrive at net factory cost. Now we are telling, okay, this is a cost incurred in factory. Outside factory also for producing, we may be incurring some cost. What are they? QRACP, quality control cost, research and development cost, administration cost specifically for production, credit for recoveries, and cost of primary packing. We get the cost of production. This is the total cost for producing the goods. Now we are telling, okay, we got the cost for producing the goods. Yes, we got the production cost for the goods produced. We want for the goods sold. So we add opening stock of finished goods. Why? Because even though they are not produced in the period, they were lying as stock, so they may be sold. So we add the cost. Reduce the closing stock of finished goods. Even though it is incurred in the period, yes, even though it is there, but they are not sold, so we reduce the cost. We arrive at the cost of goods sold. It is the production cost, but for the goods sold. We add administration overheads, add selling and distribution overheads. We arrive at the total cost. That is the cost of sales. Add profit. We arrive at sales. This is the comprehensive cost sheet. Now, few certain notes and adjustments. Firstly, direct material. Which one to consider? Should we consider the material purchased or should we consider the material consumed? Remember, only consumption is the cost. Merely because we have purchased the material, it is not cost. We may return the goods as well. Only if we consume the material, it is cost. So we are telling, okay, we had opening stock of 100 units. We have purchased 1000 units. So total 1100 is there, out of which 500 is lying as closing stock. So we have consumed only 600. Only consumption will be taken because only consumption is cost. So how do we get consumption? It is opening stock plus purchase minus closing stock. So whenever we are showing the direct material cost, we will be showing the cost of material consumed. Next, certain special items, carriage inward. If you have incurred any amount for carriage inward, we will add. Purchase return, we will reduce it from the cost. If we have any abnormal loss, we will reduce it. For example, suppose we have purchased 1000 units at the rate 1000. In the direct material cost, we originally shown as 1000. But in the store, what happened is 100 units, we have lost it by theft. It is due to abnormal reason. Okay. So due to abnormal reason, we have lost 100 units. So we are telling anything due to abnormal factor, we will not include it in cost. Anything if it is because of normal factor, we will incorporate in cost. This is because of abnormal factor. So we will tell, okay, we only have 900 units. For that, we have incurred a cost of 900. So if you have abnormal loss, that cost we will reduce. Originally it is shown, so from that we will reduce. Next, NRV of normal loss also will be reduced. Suppose we have bought sugarcane. We have purchased 10-ton sugarcane at the rate 3,000 per ton. We have paid 30,000 rupees. So we are trying to manufacture sugar. So much will be waste. Normal loss, we are expecting 40% will be normal loss. Yes, that is 4 ton will be normal loss. So whatever is the loss, we can sell it as scrap. Yes, so we have sold it. We have got 250 per ton. So we will be making a total recovery of say 1,000 rupees. So this one we will reduce it from our cost. We'll tell originally we have paid 30,000, but from that NRV of normal loss we have received 1,000. So our net cost is only 29,000. So if we have NRV of normal loss, that also will be reduced. Clear, students? Next, for direct labor or direct expense, we need to consider the cost incurred, not the cost paid. All these are certain adjustments which may appear. Yes, cost incurred. Suppose wages paid is 10,000. At the end of the year, we have outstanding wages of 2,000. We have paid only 10,000, but 2,000 is outstanding, which will be paid next year. So that also will be added. We are telling what is the cost incurred, whether it is paid or not is irrelevant. So if we have closing outstanding, we will add it. If you have any prepaid amount, this year we have paid 20,000. The wages was only 12,000, 8,000 extra we have paid. So from paid, we will reduce the closing prepaid. Yes, for opening balance, we will reverse it. So here it is add, here we will reduce it, here it is less, we will add it. It's a reverse adjustment. Factory overheads, it is also called as works overheads, manufacturing overhead, production overhead. Gross factory cost to net factory cost, why we are adding, reducing, we've already discussed. Yes, cost incurred for production but outside the factory, QRACP we have discussed. Cost of production to cost of goods sold already discussed. Some special points. Firstly, packing cost. Whenever question is telling packing cost, we have to see whether it is specifically telling primary packing or secondary packing. Primary packing will come for producing the goods. It is necessary for producing the goods. It will come in those QRACP, primary packing. So it will come there. But secondary packing, yes, secondary packing is incurred so that we can sell the goods or to distribute the goods. Yes, so it will come as selling and distribution overheads. So secondary packing will come as selling and distribution overheads. Primary packing will be coming in QRACP, cost of primary packing. Next, if question does not specify the overhead, question does not tell, is it factory, administration, selling and distribution, will be treating it as factory overheads. Next, in all the cost sheet problems, wherever we have stock adjustments, we have to add the opening stock, reduce the closing stock. Just a shortcut. Yes, direct material, we want the consumption. So we add opening stock of raw material, less closing stock of raw material. Factory cost. Yes, from gross factory cost, we add opening stock of work in progress, less closing stock of work in progress. Cost of goods sold. We have the cost of production, add opening stock of finished goods, less closing stock of finished goods. Everywhere we have stock adjustments, it is add opening stock, less closing stock. Next, abnormal cost or abnormal loss. Abnormal cost does not form part of cost sheet. We've told, yes, we've already discussed the principle of costing. Only normal items will be included. Any abnormal item will not be included. Suppose we are purchasing material. Yes, for purchase we have paid 30,000. For transportation we have incurred 2,000. As a fine we have paid 10,000. This fine is an abnormal cost. So while we are showing material cost, we will be only showing 32,000. This 10,000 will not show in the cost only. So it will not appear in the cost sheet only. Yes, say penalty, fine, damage, demurrage, etc. Abnormal loss. It is already a part of cost. So what we do, we will eliminate it by reducing it. It is a loss. This was a cost. Yes. What happens? Abnormal loss. We purchased 1,000 units. We have paid 1,000 rupees. Then what happened? Theft happened of 100 units. Now we are only having 900 units. This was abnormal loss. We've already showed 1,000 rupee cost. From that we reduce for 100 unit 100 rupees. Net 900 rupees is the cost. Okay. So if it is abnormal cost, it will never form a part of cost sheet. Abnormal loss, it is already included in cost, so we'll reduce it from cost and thereby we eliminate it. Clear? Next, subsidy grant incentive. If you have received any subsidy grant incentive, we will reduce it from the respective cost. Suppose we have got subsidy for buying material. From material cost, we'll reduce it. Okay. Yes. Next, interest and other financing cost. They are shown as a separate line item after selling and distribution overheads. We've arrived at cost of goods sold. We add administration overheads, selling and distribution overheads. If question is telling us interest and other financing charges, that also will be added at the end. Then we will get what is the total cost. That is the cost of sales. Clear? Yes. With this, more or less, the chapter cost sheet is over. We have certain items from blast from the past, important adjustments from an exam perspective, some important categorization. Firstly, freight inward, freight for buying the material. Yes, it will be shown as a direct material cost. Contribution to ESI or production bonus, shown as direct labor cost. Job work charges, job work. To manufacture the jeans, I'm not having my own labor. Yes, I give it on job work basis to a third person and tell, for you, I'm giving 300 rupees per jeans. Stitch it and give it to me. Is it the material cost? No. Is it the labor cost? He is not my employee. It is the direct expense cost. Repairs and maintenance of director's vehicle. Director's vehicle. Overheads, it is administration overheads. Insurance premium for stock of raw material or work in progress. Where will be having work in progress, stock and all? Why are we using it? It is used in factory for producing. So it is overheads in the factory overheads. Now, traveling allowance for office staff, administrative overheads. Pollution control expense. To ensure where pollution is emitted, pollution will be emitted in the factory. So we need to ensure it is within the specified limit. So we need to do the checking, ensure compliance and everything. So where it is incurred? In the factory. So it is factory overheads. Now, expense for administration of factory work. Administration. Yes, is it administration overheads? No. It is administration cost, but specifically relating to production. Yes, one of those special 5 costs, QRACPA, administration cost specifically for production. Next, functional manager salary for production. Functional manager will generally be there in the office, but what is he looking at? He's looking at the production. This is administration cost, but specifically for production. This will also come here. Next, expense for utilities. Again, it is direct expense. If we have GST on raw material, we will see whether credit is available. If credit is available, it is not cost. But if credit is not available, it is cost. Yes, why are we incurring GST? For buying the material, so it will be shown as direct material cost. Next, where an item of cost is given as percentage of other item of cost. Suppose question is telling direct wages is 17,500, which is 175% of works overheads. Works overhead is nothing but factory overhead. So direct wages is 175% of works overhead. What is direct wages? 17,500 is 175% of works overhead. Therefore, works overhead is 17,500 divided by 175%, which comes to 10,000. Clear? All small adjustments. Next, preparation of cost sheet where one of the item is missing. Yes, in one question, what happened was material purchase was missing. Question has not specified what is the amount of goods we have purchased. Opening stock of raw material is there, closing stock of raw material is there, but material purchase is not available. Material purchase is not available, we will not be getting the direct material cost. Direct material cost is not available, we cannot prepare the cost sheet only. But what happened in the question? Some other item will be available. Say cost of goods sold was available. So in such a case, what we do? Cost of goods sold total, what we know. So we will take the missing figure as X, draw the cost sheet till there and find the missing figure. So what we'll do is, suppose we have opening stock of raw material 10,000, closing stock 6,000. We'll tell, okay, what is the direct material consumed? It is opening stock plus purchase. We don't know what is the purchase. We'll take purchase as X minus closing stock. So we get it as X plus 4,000. This is the material consumed. So we take direct material as X plus 4,000, direct wages, direct expense, get the prime cost, do everything, arrive till cost of goods sold. We'll be getting cost of goods sold as X plus something. Yes, do all the things, will arrive at cost of goods sold. Suppose we got cost of goods sold as X plus 60,000. Now we know what cost of goods sold is. We can equate and then find the value of X. So if we equate it in this equation, we'll get X plus 60,000 is equal to 85,000. Therefore, X, that is material purchase, is nothing but 25,000. Clear? Next. If the cost of closing stock of finished goods is not available, sometimes finished goods units would be available. 400 units are finished goods, closing stock of finished goods, but cost is not available. So in such a scenario, what do we do? Method of valuation comes into picture. Either it may be FIFO or it may be weighted average. In FIFO, how do we get the cost per unit? Cost per unit in FIFO is cost incurred in the period divided by units manufactured in the period. What is the cost in the period divided by what is the units in the period? We get the cost per unit. Weighted average, we don't tell in this period or in the previous period opening stock, we don't care. We see what is the total cost divided by total units. It is the cost till date divided by units till date. How this formula has come, the detailed discussion was already done in the chapter process costing. Now directly continuing, see, look at this. Cost of production. We have produced 1,000 units. For that, we have incurred 1 lakh rupees. Extra, we had 100 units as opening stock of finished goods. For that, 12,000 was the cost. If we are using FIFO, what we'll tell? Okay, in this period, what is the cost? 1 lakh. In this period, what is the units produced? 1,000. So the cost will be 100 per unit. Weighted average, what it tells? Whether it is in this period or the previous period, opening stock does not make a difference. See, what is the total cost? Total units. Total units is 1,100. Total cost is 1,12,000. So as per weighted average, we tell 1,12,000 is the cost incurred for 1,100 units. So it will be 101.8. Clear? So, and in question, if nothing is given, question has, we know what is the closing stock in terms of units, but question has not specified value closing stock using FIFO, using weighted average. Then we'll be valuing using FIFO. Clear? Next, sometimes question may ask us to calculate the cost per unit. Total cost anyways, it's available. Cost per unit, we need to calculate. Remember these 3 simple rules. Till the cost of production, whatever is the cost available, direct material, direct labor, direct expense, factory overheads, everything. We want the cost per unit. So we need to divide by number of units. Which number of units will take? Till cost of production, we are incurring for the goods produced. So we'll be dividing it by the units produced. After cost of production, we have add opening stock of finished goods, less closing stock of finished goods, we get cost of goods sold. Then we have administration overhead, selling and distribution overheads. This one will be dividing it by the units sold. Clear? And wherever we have stock adjustments, we will just ignore them. So remember 3 things. Till cost of production, divide by units produced. After cost of production, that is administration overheads and selling and distribution overheads, divide by the units sold. Wherever we have stock adjustments, add opening stock, less closing stock, wherever we have for raw material, work in progress, finished goods, just ignore them. Clear? Now, one more thing is, if company is producing multiple products, then we have to prepare a separate cost sheet for every product. That is clear. Suppose question is telling company is manufacturing product A and product B. Okay. Total material cost is 1 lakh rupees. All in all, for the material, we've incurred 1 lakh rupees. Okay. But we don't know what is for product A, for product B. We want specifically product wise. Yes. Now, what is question telling? Product B consumes twice the amount of material as product A. What is the question telling? If product A is taking one unit of raw material, product B will be taking 2 units of raw material. Next, what is the unit produced? Product A 40,000, product B 80,000. So product A 40,000, product B 80,000. We know the total cost as 1 lakh. Yes. Quantity per unit into number of units, we get the value. In that ratio, we will distribute 1 lakh cost. So we tell 1 into 40,000, 40,000, 2 into 80,000 is 1,60,000. So this 1 lakh rupee cost will be distributed in the ratio 40,000 is to 1,60,000. Instead of 1 and 2, we can also take it as x and 2x and respectively create an equation, solve and calculate what is the material for product A, what is the material for product B. Clear? This was the chapter cost sheet, one of the most important chapter from the exam perspective. Yes, we've had a very good look at it. Now let us move to the next chapter, cost accounting system. Cost accounting system, on an average, we have 6 marks, falls in the B category. We have 3 main things in this chapter. Cost accounting system. For accounting, cost accounting, we have the non-integral accounts, integral accounts, and then we have reconciliation. So firstly, for cost accounting, to get what is the cost related data, we need to account for the cost. How we can account for the cost? We have 2 different systems. First is the non-integral system. Yes, we already have financial accounting. We are maintaining all money related data. We are telling, okay, let us maintain separate records for costing. So what we are doing in non-integral system, we are maintaining separate set of accounts. One records we are already having for accounting, financial accounting. Now we are having a separate set of accounts for costing. So we have separate for accounting, separate for costing. In this we'll be getting separate profit. In this we'll be getting separate profit. 2 separate profits will be there. We want to see why is there a difference. So we'll be doing a reconciliation. So reconciliation of profit is required in non-integral system because 2 separate system of accounts are maintained. Integral system, only a single set of accounts are maintained. So we'll be getting only a single profit. There is no need for reconciliation. Clear? So in non-integral, only cost related data are maintained. To produce the goods and distribute the goods or services, what is the cost incurred? Other things we are not maintaining at all. In integral, everything will be maintained because financial accounting data is also maintained, cost accounting data is also maintained. So golden rules of accounting, yes, 3 types of accounts: personal account, real account, nominal account. In integral, everything, costing, financial, everything will be maintained. So all accounts will be maintained. In non-integral, only the cost data is maintained. To produce and distribute the goods or services, what is the cost incurred? Personal account details will not maintain. Real account details, that also will not maintain. Nominal, expenses and income. Here also we ask, is it relating to production, distribution of goods or services? Is it relating to cost? If yes, we maintain. Others, if it is not pertaining to cost, say for example, dividend we have received, we will not maintain those data. Okay, in integral, every type of account will be maintained. Non-integral, only nominal. In that too, if it is relating to production, distribution of goods or services, only that will be maintained. Now, in non-integral accounts, we need to know what is the system of GLA. General Ledger Adjustment Account. Other names: General Ledger Adjustment Account, General Ledger Control Account, Cost Ledger Adjustment Account, Cost Ledger Control Account. Yes, what is this? This is an account which is created to complete the double entry. What happens in non-integrated accounts? Only nominal accounts are maintained. So sometimes we may not be having debit or credit. So to complete the corresponding debit or credit, yes, we create an account which is nothing but a dump yard, which is called as general ledger adjustment account. For example, if you have purchased raw material on credit, in financial accounts, what will show? Okay, we have purchased the goods, purchase account on credit to creditor. Cost accounts, yes, we have purchased the goods. Goods purchased, they will be going to store. We are maintaining goods at a separate place called as stores. So we're telling, okay, stores ledger control account. To creditor, goods purchased on credit. For us, for costing, whether goods is purchased on credit, goods is purchased on cash, goods are purchased on barter, does not make a difference. We are only concerned with cost. Yes, goods are purchased, what is the cost? That's all. So we are telling, okay, stores ledger control account. Creditor, X, Y, cash, whatever it is, does not make a difference. So to GLA. So wherever debit or credit is not available, we transfer it to GLA. Clear? Yes. So we will be having 3 different type of transaction, all in all. So we may be having either pure financial transaction, say for example, payment to debtors. They will not come at all in cost account. We are not concerned at all. Then we'll be having pure costing transactions. Both debit as well as credit will be coming in costing. Say for example, material is issued to production. From stores, goods are going to production for the factory, which are in work in progress state. So it will be work in progress control to stores ledger control. Or then we'll be having the mix or hybrid transactions, wherein one will be costing, one will be financial. Say for example, material purchased on credit. We want what is the material purchase, whether it is cash or credit or barter, whatever it is, does not make a difference. So we have stores ledger to GLA. So wherever we will be having these hybrid transactions, GLA will be coming. Okay. Now, what are all the accounts we will be opening in non-integrated accounts? We only want data relating to cost. Everything apart from that will be transferring to an account called as general ledger adjustment account. Yes. Now, what all are the elements of cost? Material, labor, expense, direct material, direct labor, direct expense. And then we have overheads, factory overhead, admin overhead, selling and distribution overheads. So for all these, we want to know what is the cost incurred for material, what is it incurred for labor, what is it incurred for expense, What is the cost incurred as factory overheads, admin overheads, selling and distribution overheads? So for all of these, we are creating a separate account. Say for material, what all is the material purchase? Yes, either maybe direct material or indirect material. We open an account called as stores ledger control account. Next, what all details relating to wages, what all wages cost are incurred? We create an account called as wages control account. Yes, it may be direct wages, it may be indirect wages. And for all the direct expense, we create an account called as direct expense control account. Next, we want to know what is the cost incurred as factory overheads, admin overheads, selling and distribution overheads. For factory overheads, we create an account called as production overhead control account. For administration overheads, we create an account called as administration overheads control account. For selling and distribution overheads, we create an account called as selling and distribution overheads control account. Clear? So these 6 accounts: for material, stores ledger control account, wages control account, direct expense control account, production overhead control account, administration overhead control account, selling and distribution overhead control account. Now, while we are producing the goods, goods will be passing through 3 stages. Goods, if they are in factory, they will be in work in progress stage. Yes, goods are still being produced. Work in progress stage they are. So it will be work in progress control account. So we want to see in factory what is the cost incurred. Goods will be in work in progress stage. Yes, so work in progress control account. Once goods are produced, they are transferred from factory to warehouse. So what is the finished goods? What is the cost of the finished goods? So finished goods control account. Next, from those finished goods, few goods will be sold. So what is the cost of the goods which are sold? So for the goods which are sold, we'll be calculating what is the cost of sales account. So we've got what is the total cost for the goods sold. As against that, we compare it with the sales, we get the profit or loss. So how do we get the profit or loss? Sales we transfer to costing P&L. Cost of sales also we transfer to costing P&L. Difference will be the profit or loss. So these are the different accounts we have. We have all in all 11 accounts. Apart from these, whatever is there will be transferred to general ledger adjustment account. Now we are going to look at every transaction, the journal entry ledger accounts quickly. Yes, firstly, material purchased. Look at the arrow. Arrow itself will tell you what is happening. So we are buying the material. In the stores, we are receiving the material. So it is stores ledger control account debit to from whom we are receiving, whether it is cash or credit does not make a difference, to general ledger adjustment account. Wages incurred, look at the arrow. Yes, wages. What is the wage cost incurred? Wage control account debit to general ledger adjustment account. Next, direct expense incurred. So what is the direct expense incurred? Direct expense control account debit to general ledger adjustment account. Clear? Now, these material will be issued to production. Yes. Direct material will be directly issued. Indirect material will go to either production overhead, administration overhead, selling and distribution overhead. From there it will be issued. So direct material, if you are issuing, yes. So from stores we are issuing direct material to the factory for producing the goods. So from here goods are going here. So from here we are transferring to work in progress. We are transferring. So it is work in progress control account debit to stores ledger control account. Direct wage cost, it is for producing the goods directly to work in progress. So from here to here, it is again work in progress control account debit to wages control account. Direct expense in the factory, yes, it is transferred, absorbed. So it is work in progress control account debit to direct expense control account. Clear? Now we have indirect material or indirect labor. They will be charged but as overheads. So first from here, from stores ledger, from wages control, we'll be transferring it to either production overhead control, administration overhead control, selling and distribution overhead control. So from here, we will credit these accounts, and if it is for factory, we'll debit factory overhead control account. If it is for administration, we debit administration overhead control account. If it is for selling and distribution, we debit selling and distribution overhead account. So it is production overhead control account debit, administration overhead control account debit, selling and distribution overhead control account debit, to stores ledger control account for indirect material, to wages control account for indirect labor. Indirect expense, directly we are recording, we are showing the cost here. So production overhead control account debit, from where whether it is paid in cash or outstanding does not make a difference, to GLA. Same thing for administration overhead control and selling and distribution overhead control. Clear? Now, work in progress, factory overheads. In the factory, what is the cost incurred? In the factory, we have added direct material cost, direct labor cost, direct expense cost. Now, factory overhead cost should also be added. So we transfer the factory overhead cost from factory overhead to work in progress control account. Journal entry is work in progress control account debit to production overhead control account. If you want to see what is a debit, what is a credit, just look at the arrow. Where the arrow is going, that account will be debit. From where it is going, that will be credit. From here, we are transferring to this account, we are transferring. Now, in the factory, whatever is the finished goods produced from factory will be transferring it to the warehouse. So that cost also we are transferring. From work in progress, we are transferring it to the finished goods. So finished goods control account debit to work in progress control account. Now, for the finished goods, we are adding administration overheads. So from administration overheads, it is added to the finished goods. So it is finished goods control account to administration overhead control account. From the finished goods which are there in the warehouse, few goods are sold. So from finished goods, cost is transferred to cost of sales. It is cost of sales to finished good control account. Again, for these goods which are sold, we want to add the selling and distribution overheads. So from here, cost is added here. So it is cost of sales account debit to selling and distribution overheads. Now we have the total cost of sale. We have the sales. Both these costs will be transferred to costing P&L. Sales will be transferred to costing P&L. Cost of sales will also be transferred to costing P&L. Difference will be the profit or loss. Clear? These were the journal entries. Now let's look at the ledger accounts, how to draw the ledger accounts. Quickly, firstly, we have the stores ledger control account. What all we are incurring the cost, we'll show it in the debit side. Yes, what all is absorbed or transferred to another account, we'll be showing it in the credit side. As simple as that. So in the stores, we already had opening stock of raw material. We'll show it in the debit side. Yes. Fresh material we have purchased. Either it may be direct material, indirect material. To GLA, we add. Whatever is the cost for buying material, maybe transportation, other expenses, that also we add to the raw material cost. So that also we show in the debit side. Now, from that, certain raw materials are returned. So from this cost, we want to reduce the cost. So we show it in the credit side, whatever is the raw material returned by GL. Next, whatever is a direct material which is issued in the factory for production. Yes, we'll be transferring the cost from here to work in progress control by work in progress control. Indirect material, whatever is issued, yes, it will be transferred either to production overhead, administration overhead, selling and distribution overhead. Then we'll be having the balance, that is the closing stock of raw material. Next, wages control account. Firstly, wages incurred in the debit side will be showing wages to GLA. Yes, now we are absorbing the wages, transferring it. If it is direct wages, direct labor will be transferring into work in progress control account. So by work in progress control account, if it is indirect wages, will be transferring to production overhead, admin overhead, selling and distribution overhead. Yes. Next, direct expenses incurred will be showing it in the debit side to GLA. Yes. Absorbed by work in progress control account by work in progress control account. Simple as that. Now we have the production overhead control account. So firstly, we'll be showing the incurred. Yes. Firstly, indirect material from stores ledger we are getting. Indirect labor from wages control we are getting. Indirect expense directly from GLA we are getting. So in the debit side, 2 stores ledger control for indirect material, 2 wages control for indirect labor, 2 GLA for indirect expense. So we've got the total production overheads. This total production overheads, we're transferring it to the factory, to the goods which are produced. We're transferring it to work in progress control. So this is overhead absorbed. Now we have the work in progress control account. In the factory, we'll be having opening work in progress. So its cost will show in the debit side. Next, in the factory, we've got direct material, direct labor, direct expense, and factory overheads. 2 stores ledger control account for direct material, 2 wages control account for direct labor, 2 direct expense control account for direct expense, and 2 production overhead control account for factory overheads. All these we are adding the cost. From here, whatever is the goods produced and transferred to the warehouse, this cost will be transferring it to finished goods control account. So from here, we transfer the cost to the finished goods control account. Now, whatever is lying as closing stock of work in progress, its amount will be carried forward. Clear? Yes, so this is work in progress control account. Next, administration overhead control account. Firstly, we are incurring the cost. If it is indirect material, we'll be getting it from stores ledger. If it is indirect labor, from wages control. If it is indirect expense, directly from general ledger adjustment. Administration overhead cost will be added to the cost of finished goods. So we'll be transferring it to the finished goods control. Next, we have finished goods control account. Finished goods control account, we are already having opening stock of finished goods that will be coming in the debit side. Extra, whatever is the finished goods produced from work in progress, the finished goods are transferred to work in progress control account. Next, for these finished goods, we are adding the administration overheads. So to administration overheads, so all costs are added. From these finished goods lying in the warehouse, few finished goods are sold. So we'll be transferring the cost by cost of sale for the units which are sold, and few more will be lying as closing stock of finished goods, that is the balance carried. Now we have selling and distribution overhead control account. Yes, if it is indirect material, we'll be getting from stores ledger control account. Indirect labor will be getting from wages control account. If it is indirect expense, directly will be adding from GLA account. Now, all these costs will be added to the units which are sold. Selling and distribution cost is incurred for the units sold. So this cost will be transferred to the cost of sales. Clear? Now we have the cost of sales. We are trying to calculate what is the cost for the goods which are sold. So from finished goods, whatever is a unit sold, units cost we add to finished goods control account. Yes, for whatever is a unit sold, the cost we add. For that, we add the selling and distribution overhead control account. Yes, we get the total cost for the unit sold. This cost we transfer it to costing P&L. By costing P&L, this cost is transferred. Now we have sales. What is a journal entry we generally put for sales? If it is in cash or on credit, cash or bank or debtors to sales. So here, whether it is cash, bank, debtors does not make a difference. So by GLA, whatever it is, we are transferring it to GLA. So for the sales made, it is GLA to sales, in the sales credit side by GLA. Now we want to transfer this sales amount also to costing P&L. So we transfer it to costing P&L, sales to costing P&L, we transfer this. Now we have costing P&L. In costing P&L, in the credit side, we have sales. In the debit side, we have cost of sales. Whatever is a difference will be profit or loss. If it is coming in the debit side, credit is more, sales is more, cost is less. In the debit, we'll be getting profit. Cost is more, sales is less. In the credit side, we'll be getting loss. Whether it is profit or loss, we will be transferring it to GLA account. Yes. Then we have GLA account. Everywhere it was coming. Yes, all those corresponding debit or credit, we put it to GLA account. We prepare GLA account. Clear? Now, accounts having opening and closing balance. As a general rule, we only have 4 accounts which can be having opening or closing balance. Which all are they? They are the 3 stock accounts and GLA account. Stock accounts, stock of raw material. It will be in stores ledger. So all stock or assets will be having a debit balance. So stores ledger will be having stock of raw material, will be having a debit balance. Stock of work in progress will be lying in work in progress control account. Yes, we'll be having a debit balance. Stock of finished goods will be lying in finished goods control account. We'll be having a debit balance. Yes. All the things should tally. The opening trial balance should tally. The total of debit should tally with the total of credit. So we'll be having a general ledger adjustment account, which will be having a credit balance. Clear? We have an exception. That is when under or over absorb is carried forward to next year. We have 3 different treatments whenever we have under or over absorption. Either carry forward to next year, or transfer to costing P&L, or charge using supplementary rate. If we have decided to carry forward under or over absorption to the next year, then their balances will also be lying. So stores ledger, work in progress, finished goods will be having a debit balance. GLA will be having a credit balance. Production overhead control account, administration overhead control account, selling and distribution overhead control account. Wherever the overhead absorbed and incurred is not the same, yes, and we've decided we will carry forward to next year, we'll be having a balance, maybe either a debit balance or a credit balance. Clear, students? Now let's have a look at 5 special items which we need to keep in mind while preparing non-integrated accounts. Firstly, under or over absorption of overheads. Generally, data of overhead incurred will be given. Overhead absorbed will not be given. So if no separate details about overhead incurred and absorbed is given, There nothing specifically is given. Then what we'll do? We will treat overhead incurred as overhead absorbed. But if specifically it is given, then under or over absorption can arise. Say for example, question is telling overhead incurred, production overhead incurred is 40,000. Question does not tell what is absorbed. So in such a scenario, what we do? We tell, okay, incurred is 40,000, absorbed is also 40,000 only. So there is no under or over absorption. But if question tells absorbed is 30,000 or absorbed is 50,000, in such a scenario, under or over absorption can arise. Now, in case of under or over absorption, what has to be done? Firstly, under absorption, when it will arise, when overhead incurred is more, absorbed is less. Yes, overhead incurred is 40,000, but we have absorbed only 30,000. This is under absorption. When is over absorption? Overhead incurred is 40,000. We have absorbed 50,000. We have absorbed more, over absorption. So production overhead, administration overhead, selling and distribution overhead. Overhead incurred will come in the debit side. 40,000 incurred is coming in the debit side. Overhead absorbed 30,000 is coming in the credit side. This is a case of under absorption. Overhead incurred is 40,000, absorbed is 50,000. This is the case of over absorption. So in case of under absorption, we'll be having balance here in the credit side of overhead account. In case of over absorption, we'll be having the balance here in the debit side of the overhead account. Now, for under or over absorption, three different treatments are possible. We've discussed in the chapter overheads. Either we may carry forward to the next year. If you're carrying forward to the next year, we'll write by balance, carry it down, we carry forward to the next year. Or we may decide to transfer it to costing P&L. So we may write costing P&L, whatever is under absorption. Or we may decide to charge using supplementary rate. If we are deciding to charge using supplementary rate, we'll transfer to three different places: cost of goods sold, closing stock of finished goods, closing stock of work in progress. So in case of under absorption, if we decide to carry forward, we'll write by balance, carry down. If we decide to transfer to costing P&L, it will be by costing P&L. That is costing P&L to production overhead, administration overhead, selling and distribution overhead control. If we decide to charge using supplementary rate, cost of goods sold account, closing stock of finished goods, closing stock of work in progress, we get it here to production overhead, administration overhead, selling and distribution overhead control account. So these will be the journal entries. In case of over absorption, it will be the exact reverse. Now, in exams, if under or over absorption arises, what we have to do? Firstly, ICAI in its exams for the chapter cost accounting, it will never ask you to charge using supplementary rate. Okay, so supplementary rate is out of the equation. Now we only have either carry forward to next year or transfer to costing. Now we will see whether opening balance of overhead account is available. If in any of the opening balances, question is telling opening balance of production overhead control account 10,000. So we get an idea that company is following a system wherein it is trying to carry forward the overhead balances to next year. So we will also carry forward to next year. But if no opening balances is available, then we'll transfer it to the costing. Clear, students? Yes. Next, in case of loss of material or loss of deficiency in stock, all important adjustments. So in stores, we have purchased a material of 100. We purchased 100 rupee material. We have issued to production 90 rupees. There is no closing stock, no opening stock. So we have purchased 100, we could issue only 90 rupees. So what happened to the 10 rupees? This is deficiency, loss. So now loss can be either normal loss, abnormal loss. If it is abnormal loss, we will not let it impact cost. We will transfer it to costing P&L. So it will be by costing P&L. That is costing P&L to stores ledger control. If it is normal loss, it will be absorbed in cost. So what we do? We transfer it to production overhead control account. We tell from overhead, as an overhead, we will absorb it to the cost. So if it is abnormal loss, we transfer it to costing P&L. It is costing P&L to stores ledger control. If it is normal loss, it will be absorbed as cost. It will be transferred to production overhead control account. It is production overhead control account to stores ledger control account. One of the most important adjustments from the exam perspective. Next, few items from the past examination. Yes. If in the question sales figure is not available. Question is asking us to prepare non-integrated accounts. Yes, all data relating to cost is available, but sales is not available. So what we do? We draw accounts up to cost of sales. And at cost of sales only, we end the question. We will not transfer the total cost of sales to costing P&L. Yes, we'll show the closing balance of cost of sales account. Yes, we'll keep the cost of sales closing balance. That is, there is no need to transfer it to costing P&L. If we transfer it to costing P&L, then we will feel that it is a loss. But in reality, sales data is not provided in the question. So we will keep the closing balance of in the cost of sales account. That is one thing. Next, in case of sales return, a very important adjustment. Yes. So we know that sales return is the opposite of sales. So what we do during sales, the exact opposite we will be doing during sales return. So firstly, let's try to understand what happens during sales. So we have sold goods of 100 rupees to manufacture and everything, we might have incurred 80 rupees. Okay. So when we sell the goods, what we show is the sale value 100 rupees. Yes, we show the sale. That is general ledger adjustment account to sales account 100 rupees. Then the cost portion. Yes, from finished goods, we transfer the cost to cost of sales. Telling finished goods lying in warehouse. From here, we are transferring it to the goods sold. So it is cost of sales 80 rupees to finished goods stock control account 80 rupees. This is two things happen during the time of sales, for the sale value, for the cost value. Now, in case of sales return, both the things will be returned. This will also be returned. Yes, this will be sales to GLA, and even this cost portion will also be returned. That is finished goods stock to cost of sales. Clear? Yes. Next, if question does not give us opening balance of GLA, remember GLA will always be having an opening balance. It will always be a credit balance. If it is not available, take it as a balancing figure. Suppose in question we have stores ledger 1 lakh, work in progress 50,000, finished goods 25,000. We know all these will be debit balance, so credit will be 1.75 lakh will be GLA. Clear? Next, 5 important journal entries wherein students may commit a mistake. Firstly, finished goods at cost. What does it mean? It means finished goods are transferred from work in progress to finished goods. So finished goods in the factory, finished goods are produced, that is transferred from work in progress to finished goods. It is finished goods control to work in progress control account. Next, cost of sales or cost of goods sold or cost of finished goods sold. That is from finished goods, they are transferred to cost of sales. It is cost of sales to finished goods control account. Clear, students? This was the first part, non-integrated accounts. Secondly, we have integrated accounts. Integrated accounts is very simple. Just remember the 3 rules. Instead of GLA, write the respective accounts. In non-integrated, we only had 11 accounts. Anything outside that, we transferred it to GLA. But here, everything, debtors means debtors, creditors means creditors, bank means bank. Every account will come. Yes, so there is no GLA account. Instead of GLA, we'll be transferring it to the respective accounts. Second, instead of costing P&L, we'll be writing the word P&L. In non-integrated, we are calculating the profit only as per costing. So we prepared costing P&L. Here we are preparing a general P&L. So whatever is the transfer, the sales, cost of sales will be transferred to P&L. Thirdly, other accounts which were not appearing in non-integrated accounts will also be included. Suppose we have debtors, creditors, cash, etc. All those accounts will also be prepared. Apart from that, everything else is the same. So we are done with non-integrated, we are done with integrated accounts. Thirdly, reconciliation of profit. We've already discussed, in case of non-integrated accounts, profit as per costing and profit as per financial accounts will be different. So there is a need for reconciliation. So in non-integrated accounts, we have two different profits. So reconciliation is different. So reconciliation is required. So what all could be the reason for difference in profit? Either they can be pure financial items, pure costing items, or the items which are available in both the places, but amount is different. Say, for example, interest, rent, dividend received, or profit or loss on sale of fixed asset, income tax, dividend, interest paid, goodwill written off, share issue expenses, preliminary expenses, donation. All these will appear in financial accounts, but they will not be in cost accounts. So because of that, profit may be varying. Or pure costing items. Say, for example, any notional cost or notional revenue, they will be appearing only in costing. They will not be there in financial accounts. Because of these also, the profits may be varying. Or items which are lying in both the places, but amount is varying. Depreciation, stock valuation, overheads. Yes, as per financial accounts, the amounts are different. As per costing, the amounts are different. Because of that, also profit keeps varying. So, whenever the profit is different, we need to reconcile the profit. So, to reconcile the profit, either we may prepare a reconciliation statement or we may prepare a memorandum reconciliation account. So, reconciliation statement, look at the format, it's simple. So particulars, whatever is add will show here, whatever is less will show here, will show the total. Yes. So we begin with profit as per one account. Say for example, we begin with profit as per cost account. Then we do all the add or less adjustments. We arrive at the profit as per the other account. Next, in case of memorandum reconciliation account, this is also the same thing. In credit side, whatever we are going to do add, we'll show it in the credit side. Whatever we are trying to do it less, we'll show it in the debit side. Yes. Again, we begin with profit as per one account. We show it in the credit side. Every item we are adding it here will come here. Yes, credit, whatever is adding, will show it in the credit side. Whatever item we are trying to reduce will come in the debit side. Net will get what is the profit as per the other account. Clear? These are the formats for reconciliation statement and memorandum reconciliation account. Now comes, how do we do the reconciliation? We are all experts in reconciliation, believe me. Yes, bank reconciliation statement, students' favorite area, right? Yes, so we can use the same method, same methodology to do the reconciliation of profits. I call it the Bharatanatyam method. Let's try to have a look at a small question wherein we try to reconcile the profit. Using that technique, you can go ahead and do every kind of reconciliation. Yes, we have a question here. HK Piano Company showed a net loss of 4,16,000 as per the financial accounts. Yes, cost accounts, however, showed a net loss of 3,28,000. Okay, following information is revealed as a result of scrutiny of figures. Okay, all items are available. Yes, we have a small reconciliation statement prepared. Here we are trying to go from costing to financial, or we can go from financial to costing as well, no issues. Now we are going from costing to financial. In costing, the net loss is 3,28,000. Yes. Now let us go everything item by item. Firstly, factory overheads under recovered 6,000. What would have happened? We have financial accounts, cost accounts. In financial accounts, whatever is the overhead incurred that we are showing. In cost accounts, only absorbed will be shown. Suppose the overhead was 1 lakh rupees. Yes, incurred. But we have absorbed less, under recovered, under absorbed. We have absorbed only 94,000 in costing. Yes, we have financial accounts, we have cost accounts. We have overheads. In financial accounts, overhead incurred will be shown. Suppose overhead incurred is 1 lakh, our profit will be reduced by 1 lakh. In cost accounts, overhead absorbed, we have absorbed less, we have absorbed only 94,000. So by 94,000, it will reduce. Now, as per costing, expense shown is less. So the profit is more as per costing. What we want to do, we want to go from costing to financial, from costing to financial. In costing, the profit is more. From costing, we want to go to financial. So from costing to financial, we will reduce it. So factory overheads under recovered 6,000, will show it in less column. Now, administration overheads over recovered 4,000. It will be the opposite of under recovery, but again, let us try understanding. Suppose overhead is 1 lakh, we've absorbed 1,04,000. Financial accounts, cost accounts. In financial accounts, we've shown 1 lakh. In cost accounts, 1,04,000. In costing, the profit is less. From costing, we are going to financial. From costing to financial, we need to add it. Simple as that. Add 4,000. Now, depreciation. Depreciation in financial accounts is 1,20,000. Depreciation in cost is 130. The difference is 10,000. Yes. Financial costing. In financial, 1,20,000 is shown as depreciation. In costing, 1,30,000 is shown as depreciation. In costing, profit is less. From costing, we want to go to financial. Costing is less. We want to go to financial. We will add 10,000. Next, we have few more items. Interest on investment, income. Transfer fee, which is credit only in financial books, income. Stores adjustment, which is also credit only in financial books. These three are income. What happened? Financial accounts, cost accounts. In financial accounts, we've shown this income. Interest on investment, transfer fee, stores adjustment. When we have credited, our profit has increased. But in costing, this is not shown. In costing, the profit is less. From costing, we want to go to financial profit. From costing, we want to go up. So we will add these. So these three items we will add. Yes. Income tax. Income tax will show only in financial accounts, will not be showing in cost accounts. So in financial accounts, we have shown income tax 1,20,000. It has reduced, but in costing, we have not shown. In costing, the profit is more. In financial, the profit is less. From costing, we want to go to financial, so we will also reduce it. Less. So here, 20,000 we will add. $1,20,000 we will reduce. 2,000 and 2,000 we will add. Yes. What is the total of add column? We will show it. Total of less column will show it. Net we will show it here. Yes, when we do that, we begin with profit as per cost account. We will arrive at the profit or loss as per financial accounts. This is how reconciliation is done. Reconciliation is very simple. Do not try by hearting things. Just go with the logic, go with the flow. Do this. Yes, whatever is our profit increasing or decreasing, and from where we are starting, just look at that. You'll be in a position to get the answers easily. So how do we do reconciliation? I've told you it's the Bharatanatyam method. Use two hands. Next, tips to solve reconciliation question. Yes. Sometimes what happens is question will ask us, question will give us the data and it will tell, yes, calculate what is the profit as per financial accounts, calculate what is the profit as per cost account, and then do the reconciliation. Full-fledged 10-mark question. So to calculate profit as per financial accounts, what we have to do? We have to prepare a trading P&L. Simple, in the T format. Every expense will show it here. Every income will show it here. Trading P&L need not be prepared separately, in a single thing. Together, every expense in the debit side, every income in the credit side, calculate what is the profit. To calculate what is the profit as per cost accounts, prepare a cost sheet. You get what is the profit as per cost accounts. Yes. Then to get the reconciliation, yes, use this Bharatanatyam method. Yes, every item you see, it is there in cost, it is there in financial. What is the difference? So when we are looking, firstly, see, we'll have to go through the 3 steps. First, look at the items which are lying in both places, but the amounts are different. It is there in financial accounts also, is there in cost accounts also, but amounts are same or amount are different. First, go on doing all those adjustments. All these things are done. Now, next, look at only items which are there only in financial accounts. Do that adjustment. Next, look at items which are there only in cost accounts. Do that adjustment. We'll be arriving at the profit as per the other accounts. Clear? With this, we have done the chapter cost accounting system as well. B category chapter on an average will be having 6 marks. The reconciliation is very important from the exam perspective, students. Shall we move to the next chapter, students? Yes. How's the Josh? So we are done with the chapter cost sheet. We are done with the chapter cost accounting system. We have 3 more chapters pending: standard costing, marginal costing, budgetary control. Let's start with the chapter standard costing. One of the most important chapter from an exam perspective. Every attempt will be having a 10-mark question. On an average, we have 9 marks from this chapter. This chapter falls in the A+ category. So we'll be discussing material cost variance, labor cost variance, variable overhead cost variance, and fixed overhead cost variance. One caveat before starting this chapter, students, my approach to explain standard costing is we dig and develop every formula. We have 40 to 50 formulas in standard costing. Every formula we dig and develop ourselves. Everything, why it is there, what it is there, how it has come, why it is plus, why it is minus, everything with the logics, we develop it ourselves. This is a super fast revision for 1 day before examination. The whole of costing we are trying to cover in 6 hours. So that level of depth will not be possible, but to an extent we'll try understanding everything in a logical way in the limited time available, so that we can crack the examination and have a quick revision 1 day before examination. Yes, so basics of standard costing. It is a technique for cost control. Costing can be done for existing goods, new goods or services. For existing goods or services, two objectives. One is cost ascertainment, one is cost control. For cost control, we have standard costing and budgetary control. Yes. So we are comparing the standard performance with actual performance, and the difference is called as variance or variance. Now, what are all the different possible variances? Firstly, we have the golden formula for costing. Sales minus cost will be the profit or loss. At the start of the year, we estimated that 300 crore will be the sales. Out of that, 200 crore will be the cost, 100 crore will be the profit. This is what the standard, the benchmark we set at the start of the year. At the end of the year, our profit could only be 10 crore. What could be the reasons? The reasons could be two. Either our sale has reduced, sale is 210, cost is 200, sale has reduced, or our cost has gone up, sale was 300 only, but cost went up. Yes. So for the fall in profit, we are trying to see what are the reasons for fall in profit. There can be two reasons, either sale has reduced or cost has increased or a combination of two. Now, cost has increased. When cost has increased, we may tell either material cost has increased, direct labor cost has increased, direct expense cost has increased, or overhead cost has increased. Even in overhead, whether variable overhead cost has increased, fixed overhead cost has increased. So every item we are going to analyze. That is what we are trying to see in standard costing. What was the standard? What was the actual? When it comes to sales, what was it? When it comes to cost, every item of cost, what is it? What is the difference? What is the reason? Now here, direct expense, generally rare in business, so we will not be discussing it, not there for CA Inter. Sales variances we'll be discussing in CA final, so that is also not there. So we are left with direct material cost variance, direct labor cost variance, variable overhead cost variance, and fixed overhead cost variance. So starting with material cost variance, here we are trying to analyze the reason for change in profit due to the change in material cost. Now, how do we get the material cost? It is nothing but quantity into price. I went to a shop, I purchased 10 pen. For every pen I paid 20 rupees. My cost is 10 pen into 20 rupees per pen, 200 rupees. Quantity into price will give me the material cost. Suppose I thought my standard was 10 units at the rate 5 per unit, 50 rupees. But in actually, I've consumed 12 units at the rate 6 per unit, 72 rupees. The overall change in cost is 22 rupees. This is the material cost variance. So material cost variance, the overall change is the standard cost of material minus the actual cost of material. How do we get the standard cost of material? Standard quantity into standard price minus actual cost is actual quantity into actual price. Now we are analyzing why this 22 rupees has changed. There are two reasons. Firstly, there is a change in quantity. Yes, 2 units change in quantity. Next, there is a change in price. So we thought it was 5 rupees, but in actuality it is 6 rupees. So the reason for change in cost, there can be two reasons, either change in quantity or change in price. Yes, change in quantity, it is called usage variance, change in the usage of material quantity. Change in price is called as material price variance. Who is responsible for quantity? Production manager is responsible for quantity. Who is responsible for price? Purchase manager is responsible for price. Now, what is the level of responsibility? Now, coming to price variance, it is happening due to change in the price. So we'll tell we are responsible for the difference in price. The standard was 5 rupees, actually 6 rupees. That 1 rupee difference in price, we are responsible. Now we got it as it is difference in price, but we want to convert it into value. So do we have difference in price? We have to convert it into value. We have difference in price. We need to multiply it with the quantity so that we get value. Which quantity to take? We'll be taking the actual quantity. Why actual quantity? Because purchase manager is responsible to buy the entire actual quantity at the right price. So we are telling, we've told you to buy 12 units. All these 12 units you should have bought at the right price. So for all these 12 units, 1 rupee per price, it's the responsibility of purchase manager. So material price variance, it is due to difference in price. It is difference in price into actual quantity. Why actual quantity? Because responsible for the entire actual quantity. Now usage variance due to change in quantity, difference in quantity. It is difference in quantity. To get value, we need to multiply with the price. Which price? Standard price or actual price? We'll be multiplying it with standard price. Why standard price? Because difference in price is already covered there. So we'll be taking only the standard price here. Clear? So we've got two formulas: material price variance, difference in price into actual quantity. Material usage variance is the difference in quantity into standard price. So material cost variance, overall it is standard cost minus actual cost. Can be two reasons: change in price, price variance, it is difference in price into actual quantity. Change in quantity, that is the usage variance, it is difference in quantity into standard price. Now Now, when we have more than one kind of material, we are trying to further analyze the usage variance. Now, usage variance can be because of change in quantity or because of change in mix. Suppose we want to prepare the juice. Guests are coming, we want to prepare a juice. So what is required? We thought milk and water is required. We thought altogether 15 liters is required, out of which 5 liters milk, 10 liter water in the ratio 1:2. In actual, to prepare the juice, we have taken 21 liters. It is 15 liter milk, 6 liter water. Now, for the increase in cost because of quantity, two factors are responsible. Firstly, quantity has changed. Secondly, we have told to mix milk and water in the ratio 1:2, but in actual, we have mixed in the ratio 5:2. So mix has also changed. There are two factors. So we want to see how much is it because of one factor, how much is it because of another factor. So we have standard quantity, we have actual quantity. We bring in a third factor called as revised standard quantity. What we try to do is we tell, okay, this total actual quantity, if we had mixed it in the standard mix, what would be the picture? We're telling, okay, 21 liters only. If we had mixed in the ratio 1:2, that is 7 here, 14 here, then what would be the impact? So we have standard quantity, we have actual quantity. What is standard quantity? It is the standard quantity in the standard mix. What is actual quantity? It is actual quantity in the actual mix. We bring in a new factor, revised standard quantity. We tell, okay, we have the actual quantity, but if this total actual quantity was mixed in the standard mix, what would be the impact? Yes, we compare standard quantity and revised standard quantity. We tell mix is the same. Both things are mixed in the standard proportion, but quantity is different. So we call it sub-usage variance. How do we get sub-usage variance? It is standard quantity minus revised standard quantity. We get the difference in terms of quantity. We multiply it with standard price. Now we are comparing revised standard quantity and actual quantity. Revised standard quantity is actual quantity in standard mix. Actual quantity is actual quantity in actual mix. Quantity is the same, but mix is different. This is due to the change in mixing proportion. We are told to mix in the ratio 1:2, but you mixed in the ratio 5:2. Because of this, this is a change in cost. So it is revised standard quantity minus actual quantity. We get the difference in quantity. We need to multiply it with standard price. So always multiplier is standard price. Why? Because the difference in price is already covered above. Now, how do we get sub-usage variance? It is standard quantity minus revised standard quantity into standard price. Material mix variance is revised standard quantity minus actual quantity into standard price. This was material cost variance. Yes, at the end of every variance, we need to write whether it is favorable or adverse. If it is increasing the profit or reducing the cost of the organization, it is favorable to us. So we'll be writing, okay, 100, it is favorable to the organization. If it is unfavorable or adverse, we'll be writing it as adverse. 100 is adverse to organization. Clear? Every answer we have written, we have framed it in such a way that if the answer is positive, we'll automatically be rating it as favorable. If it is coming as negative in the calculator, we'll be rating automatically as adverse. Now, budget versus standard versus actual. An important thing. Firstly, whenever we are telling standard quantity, it is the standard quantity for actual output. And actual quantity is the actual quantity for actual output. Only if it is standard quantity for actual output and actual quantity for actual output, only then we can compare. See, suppose we are telling to manufacture one shirt, we want 2 meters. Yes. In actual, we have manufactured 10 shirt. For manufacturing 10 shirt, we have taken 19 meters. 2 meter and 19 meter, we cannot compare because 2 meter is for one shirt, 19 meter is for 10 shirt. So this is called as budget. Whatever will be given in the question, we'll be telling it as budget. Okay, this is the budget. We want 2 meter for one shirt. Standard is the standard for actual output. Telling, okay, for one shirt, we want 2 meters. So if you had manufactured 10 shirt, how much meter you would have required? We would have required 20 meters. Now we can compare because this is also for 10 shirt, this is also for 10 shirt. So whenever we are telling standard quantity, it is the standard quantity for actual output. Look at a small example here. Budget is given. Okay, for 10 units, 20 kg is required and the price is 10 rupees per kg. Yes, Price will be the same, no impact. Actually, we've manufactured 100 units, and to manufacture 100 units, we've taken 220 kgs. We're telling, okay, for 10 unit standard, we want 20 kg. This is a budget. In actual, we've manufactured 100 units. So for 100 units, how much is required? Cross multiplication, for every unit, 2 kg is required. So for 100 unit, 200 kg would be required. So standard quantity is 200 kg. Remember that every time while we are comparing, the output should be the same actual output. Next, purchase versus consumption. Which one should we take? Yes, suppose we have opening stock of 100, we have purchased 1000, total 1100. Out of that, closing stock of 500 is there. So 600 unit is the units consumed. While we are seeing material cost variance, cost, when is the cost? It is only when we have consumed the materials. Merely if you have purchased, it is not cost. We can return the goods. Only if you have actually consumed, it is cost. So every variance will be based on the material consumption. So for the actual quantity, take the material consumed. So how do we get material consumption? Consumption is nothing but opening stock plus purchase minus closing stock. Clear, students? Now, one final revision of material cost variance. Material cost variance, we are trying to see the difference in profit due to difference in material cost. Material cost is nothing but quantity into price. Material cost variance, it is standard cost minus actual cost. It is standard quantity into standard price minus actual quantity into actual price. It can be because of two reasons. One is change in price, one is change in quantity. Change in price, price variance. It is difference in price into actual quantity. Change in quantity, usage variance. It is difference in quantity into standard price. If we have more than one quantity, now we have sub-usage variance and mix variance. So we are comparing standard quantity, we have actual quantity, we bring in a new element called as revised standard quantity. Revised standard quantity is actual quantity in the standard mix. So when we are comparing standard quantity and revised standard quantity, so we tell the mix is the same, but quantity is different. So it is sub-usage variance, that is standard quantity minus revised standard quantity into standard price. We're comparing revised standard quantity and actual quantity. Quantity is the same actual quantity, but mix is different. So we call it as mix variance. It is revised standard quantity minus actual quantity into standard price. This is material cost variance. Now moving to labor cost variance. In labor cost variance, we're trying to analyze the reason for change in profit due to change in the labor cost. And how do we get the labor cost? It is nothing but hours into rate per hour. An employee is working for 8 hours. For every hour I'm paying him 100 rupees, it is 800. Hours into rate per hour will give us the labor cost. Labor cost variance, we have two different variances. First, when no idle time is there. Secondly, when idle time is there. Firstly, let's try to get when no idle time is there. Firstly, without idle time, if we know the logic for material cost variance, labor cost variance and variable overhead cost variance is going with the same logic. Okay, labor cost variance, overall change in cost, we see what is the standard cost, what is the actual cost. Standard cost is standard rate into standard hours minus actual rate into actual hours. Now, why can there be a difference in labor cost? Either because rate has changed, that is difference in rate, or because hours have changed, difference in hours. Difference in rate is called as labor rate variance. Difference in hours, for employee we have given 10 hours to do the work, but he has actually taken 15 hours. Employee is not efficient. Efficiency variance. So how do we get the labor rate variance? It is a difference in rate. To get a value, we need to multiply with hours. Which hours will be multiplying with the actual hours? Because the responsibility to recruit at the right rate was for the entire actual hours. So labor rate variance, difference in rate into actual hours. Now, efficiency variance, difference in hours into standard rate. Why standard rate? Because the difference in rate is already covered. Yes. Now, if we have more than one category of employees, the same way we have discussed in material cost variance, further analysis. Suppose we have skilled employees, semi-skilled employees, and unskilled employees. Standard, what we estimated was skilled employees 15 hours, semi-skilled employees 15 hours, unskilled employees 15 hours. Total 45 hours is required. That is in the ratio 1:1:1. But in actual, what happened? Employees have actually worked for 60 hours in the ratio 3:2:1. So now we are telling, okay, we are calculating revised standard hours. We're telling, okay, Assume they had worked for 60 hours, actual hours they had worked. But if they had worked in the standard mix, 1:1:1, what would have happened? It is 20 hours, 20 hours, 20 hours. So we bring in a new factor called as revised standard hours. So we are telling we have standard hours, that is standard hours in the standard mix. We have actual hours, that is the actual hours in the actual mix. We bring in a new factor called as revised standard hours. We're telling, okay, the actual hours, if we had mixed it in the standard proportion, what would be the case? So when we are comparing standard hours and revised standard hours, here mix is the same, but hours are different. It is called sub-efficiency variance. How do we get sub-efficiency variance? Standard hours minus revised standard hours. We get the difference in terms of hours. We get value multiplied by rate. We are taking standard rate because difference in rate is already covered. Now, here we are comparing revised standard hours and actual hours. Here hours is the same, but mix has changed. So we call it the labor mix variance, or it is also called as the gang variance. How do we get the mix or gang variance? It is revised standard hours minus actual hours. We get the difference in hours to get value multiplied with standard. So this is labor cost variance without idle time. Labor cost variance, two reasons: rate variance, efficiency variance. Efficiency variance, further analysis, it can be sub-efficiency variance or gang or mix variance. Clear? Now, from material cost variance to labor cost variance, I've told it's the same logic. Yes, in material cost, we've got it as quantity into price. Labor cost, we're getting it as hours into rate per hour. If you know only the things which are changing, in material, we've taken the quantity. In labor, we'll be taking the hours. For material, we had the price. For labor, we have the rate. Material, we took the material cost variance. Here we have the labor cost variance. There we had the price variance. Here we have the rate variance. There we had usage variance. Here we have efficiency variance. There we had a mix variance. Here we have gang variance. There we had sub-usage variance. Here we have the sub-efficiency variance. This is labor cost variance without idle time. Now, labor cost variance with idle time. What is idle time? Idle time is the hours for which employee is getting payment, but no work is done. Yes. Look at the hours chart. For a work to manufacture a shirt, standard hours allowed is 8 hours. We were told manufacture the shirt in 8 hours. Actual hours the employee has worked is only 7 hours. Yes, to manufacture the shirt, actually he has taken only 7 hours. So we think he is very efficient. But we are making him payment for 10 hours. Actual hours paid is 10 hours. Actual hours worked is 7 hours. Actual hours paid is 10. Yes. So the difference for 3 hours, even though no work is being done, he's still getting the payment. The 3 hours is the idle time. 7 hours is the actual hours worked. 10 hours is the actual hours paid. The difference is idle time. Clear? Yes. So when we have labor cost variance with idle time, an extra variance, idle time variance is added. Now, a small shortcut to remember all the variances. Wherever we have actual hours, we'll now be having a doubt whether should we take actual hours worked or actual hours paid. So remember, the first two variants, that is labor cost variance and labor rate variance, is on actual hours paid. This is a shortcut. Labor cost variance, labor rate variance is on actual hours paid. Idle time variance is on difference between actual hours paid and actual hours worked. Next, all other variances are based on actual hours worked. Now let's try to look at the formulas individually. First, we have the labor cost variance, that is standard cost minus actual cost, is standard rate into standard hours minus actual rate into actual hours. When we are taking actual hours, we want to see the overall change. It is the actual hours paid. Reasons, it can be because of change in rate or change in hours. Change in rate is the labor rate variance. We tell it is the difference in rate into actual hours responsible for the entire actual hours. So it is actual hours paid. So first two variances is based on actual hours paid. Now we are looking at difference in hours. Difference in hours, it can be either idle time variance or efficiency variance. Idle time variance, it is idle time hours. Yes, 7 hours worked, 10 hours paid, 3 hours idle time. Yes, we get it in terms of hours. To get value, we multiply by rate multiplied by standard rate. Why standard rate? Because difference in rate is already covered. So it is idle hours into standard rate. Remember, idle time variance is always adverse. Next, we have efficiency variance. How do we get efficiency variance? It is a difference in hours into standard rate. Now, when we are taking difference in hours, it is standard hours minus actual hours. Should we take actual hours worked or actual hours paid? We should take actual hours worked. Why? Look at this. We are trying to compare the efficiency of an employee. Employee is telling, see, 8 hours was assigned, standard hours allowed was 8 hours to manufacture this shirt. Actually, I have produced this shirt in 7 hours itself. I am very efficient. I have taken less time. Yes. This 3 hours extra was abnormal idle time. It was because power was not there, so I couldn't do anything. My work, I have done it in 7 hours itself. So when we are comparing efficiency, we are taking standard hours with actual hours worked. So it is standard hours minus actual hours worked into standard rate. Again, if we have more than one category of employees, we have sub-efficiency variance and we have mix or gang variance. The same logic applies. We have standard hours, we have actual hours worked, then we have the revised standard hours. That is actual hours worked in the standard mix. We are comparing standard hours and revised standard hours. Here mix is the same, but hours is different. It is sub-efficiency variance. That is standard hours minus revised standard hours into standard rate. We are comparing revised standard hours with actual hours worked. Here hours is the same. It is the same actual hours worked, but mix is different. So it is called mix or gang variance. That is revised standard hours minus actual hours worked. We get it in terms of hours into standard rate. Shortcut to remember labor cost variance with idle time variance. Whether should we take actual hours worked or actual hours paid? Firstly, remember all the name. Labor cost variance, change in rate, change in hours, change in rate, labor rate variance, change in hours, idle time variance, efficiency variance. Efficiency variance, further analysis, it can be sub-efficiency variance, gang variance. Now, should we take actual hours worked or actual hours paid? First two variances, cost variance and rate variance, is on actual hours paid. Next, idle time variance is on the difference between actual hours paid and actual hours worked. It is always reverse. Next, all subsequent variances, that is efficiency, sub-efficiency and gang, is on actual hours worked. Clear, students? Next, we have variable overhead cost variances. Here we are trying to analyze the reason for change in profit due to change in variable overhead cost. For variable overhead, firstly, we need to calculate what is the standard recovery rate. Suppose budgeted overhead is 1 lakh. This budgeted overhead, we are trying to calculate the recovery rate. Yes, budgeted overhead, we are estimating the overhead will be 1 lakh. We are estimating this 1 lakh will be for 10,000 unit. So we get SRR per unit. It is 1 lakh divided by 10,000 units will be 10 per unit. SRR per hour, we are telling, okay, it is 1 lakh overhead for 25,000 hours. It will be 4 per hour. So how do we get? SRR per unit is budgeted overhead divided by budgeted units. SRR per hour is budgeted overhead divided by budgeted hours. Now, variable overhead is an overhead which varies with the change in level of activity. It may vary based on number of hours or number of minutes. Now, example, suppose electricity, variable overhead. Yes, standard, we thought that electricity may be required for 10 hours at the rate 10 per hour, it may be 100. But in actual, it came to 12 hours at the rate 12 per hour, 144. Firstly, what is the overall change in variable overheads? We thought it was 100, but in actual it is 144, 44 rupees. The overall change in variable overhead cost is the variable overhead cost variance. It is standard variable overhead cost minus actual variable overhead cost. Now, what all could be the reasons? There can be two reasons. Firstly, hours have changed. We thought it was 10 hours, but it is 12 hours. Secondly, the rate has changed. We thought it was 10 per hour. Actually, it is 12 per hour. So, change in hours is called as efficiency variance, and the change in the rate is called as expenditure or budget variance. Now, variable overhead cost variance, the logic again going back to material cost variance only. Variable overhead overall change, it is standard cost minus actual cost. Standard cost is SRR per hour into standard hours minus actual recovery rate per hour into actual hours. What all could be the reasons? Either there is a change in the recovery rate, SRR and ARR, it is change in rate, or change in hours. change in rate is called expenditure or budget variance. It is difference in rate into actual hours. Why actual hours? Because responsible for the entire actual hours. So it is SRR per hour minus ARR per hour into actual hours. If we expand this, SRR per hour into actual hours minus ARR per hour into actual hours, this will give us the actual overheads. So this is SRR per hour into actual overheads minus actual overheads. Even if you write it this way, it's the same thing. Generally what happens, actual recovery rate per hour will be in decimal. That is why when we do this, we get it in total. Okay, next, efficiency variance, difference in hours. It is difference in hours into SRR per hour. Why standard recovery rate per hour? Because difference in rate is already covered. So it is standard hours minus actual hours into SRR per hour. This is variable overhead cost variance. So we have variable overhead cost variance. Change in rate is the variable overhead expenditure or budget variance. Change in hours is the variable overhead efficiency variance. Clear, students? So we have discussed material cost variance, labor cost variance, variable overhead cost variance. We are left with fixed overhead cost variance. Here we are trying to analyze the reason for change in profit due to the change in fixed overheads. Till here we were only comparing standard, actual, standard, actual, standard, actual. But here, when it comes to fixed overhead, budgeted overhead is also important. I'll give you a small example. I've got into teaching. So I thought my fixed overheads, I'm budgeting, it will be 1 lakh rupees. For the purpose of teaching, rent and etc., everything else, the budgeted overheads would be 1 lakh. This is what I thought. Yes. I thought I'll be teaching for 1,000 students. So from every student, I'll have to recover 1 lakh divided by 1,000, 100 per student. This is my recovery rate. In actual, I thought I'll teach for 1,000 students, but in actual, I could only teach for 900 students. So what is the total absorbed overhead? I recover 100, 100, 100, 100 per student into 900 student. So it is 100 per student into 900 student. 90,000 is the absorbed overhead. Okay. Now, actual overhead is 1.2 lakh. I thought that my overhead budgeted would be 1 lakh, but in actual, the overhead turned out to be 1.2 lakh. Yes. Now, look. We have 3 elements here. Firstly, we have the standard, that is the recovered overhead, SRR per unit into actual output. From every student, I recovered 100, 100, 100 into 900 students, 90,000. Actual overhead is 1,20,000. So I'm telling the overall change. I've recovered 90,000, I've incurred 1,20,000. Overall change in fixed overhead cost is 30,000. Now I'm trying to analyze the reason. So budgeted overheads will also be relevant. I'm telling budgeted overhead is 1 lakh. Now look what is happening. I'm telling fixed overhead should not have changed irrespective of output. So whether it is 100,000, 10,000 units, fixed overhead should have been the same. So when you budgeted it as 1 lakh rupees, why is there a change from 1 lakh to 1,20,000? Yes. So this is because budgeted overhead is not equal to actual overhead. I budgeted my amount will be 1 lakh, but in actual it came to 1,20,000. So because of that, I have a 20,000 difference. Now again a 10,000 difference. Why I'm having? Okay, I budgeted 1 lakh rupees will be my overhead. I'll absorb it as 100, 100, 100, 100 from 1,000 students. But in actual, I could only absorb it from 900 students. Yes, my budgeted output is not equal to my actual output. I thought I'll be teaching for 1,000 students, but in actual, I could only teach for 900 students. Yes, this is one reason. Second thing is budgeted overhead is not equal to actual overheads. So the overall 30,000 change can be because of 2 reasons. Firstly, budgeted overhead is not equal to actual overhead. Yes, this we call it as budget variance or expenditure variance. Yes, this is based on the change in overhead cost. Yes. Which is favorable? Budgeted overhead is more than actual overhead is favorable. Suppose budgeted overheads, we thought that our overhead will be 1 lakh, but in actual, the overhead only came to 70,000. We're telling, okay, actual overhead is less, that is favorable for us. So budgeted overhead more than actual overhead is favorable. So the formula will be budgeted overhead minus actual overhead. We are framing formula in such a way that if it is positive, we'll be writing it as favorable. Now, coming here, we are comparing standard and budget. Yes, We've absorbed 90,000. The budget was 1 lakh. Why we could not absorb 1 lakh? Because our output, we thought it was 1,000, but in actual we could only teach for 900 students. Which is favorable? Actual output more than budgeted output is favorable. Yes, think of it. My budgeted output, I thought I'll be in a position to teach for 1,000 students. But in actual, I thought for 1,500 students. So from 1,500 students, I went on absorbing 100, 100, 100. That is favorable for me. So it will be actual output minus budgeted output. We are creating formula in such a way that if it is for positive, it will be favorable. Yes, actual output minus budgeted output, we get the difference in terms of unit. Actual output 1,500, budgeted output 1,500 units. So multiplier is SRR per unit. Why SRR? Because the difference in the recovery rate is already covered here. Yes, so it is SRR per unit into actual output minus budgeted output. This is due to change in output. It is called as volume variance. One more is due to change in the overhead cost. It is called the budget or expenditure variance. So firstly, we have the fixed overhead cost variance. It is standard cost minus actual overhead cost. Two reasons: either actual output not equal to budgeted output, it is volume variance, it is SRR per unit into actual output minus budgeted output. Secondly, budgeted overhead cost is not equal to actual overhead cost, cost based. It is called the budget or the expenditure variance, which is budgeted overhead minus actual overhead. Clear? So fixed overhead cost variance, overall change, it is the standard overhead minus actual overhead. Standard is SRR per unit into actual output minus actual overhead. It can be because of two reasons. One is budgeted output is not equal to actual output, or budgeted overhead cost is not equal to actual overhead cost. This is called as the budget or the expenditure variance. It is cost based, the difference in cost from budgeted cost to actual cost. We budgeted it was 1 lakh, in actual it is 1,20,000. So it is budgeted overhead minus actual overhead. Second, okay, why did we not absorb 1 lakh? Because our actual output was less. So it is based on output. It is called as volume variance. It is actual output minus budgeted output. We get the difference in terms of units multiplied by SR. Now, further analysis of volume variance. Now we are telling, okay, budgeted output 1,500. How did we get? Small example. I thought I will be in a position to solve 1,500 questions. This was my budget. Yes. How did I get this budget? I thought I will be studying for 25 days in a month. And every day I'll be studying for 10 hours. And for solving every question, I want 10 minutes. So what will happen? Yes, 10 minutes per question. So in an hour, I can solve 6 questions like this. 10 hours in a day into 25 days, I'll be in a position to solve 1,500 questions. This was my budget. But in actual, I've solved 2,000 questions. Favorable for me? Yes, actual output more than budgeted output is favorable for me. Yes. Now, what all could be the reason? I thought I'll be solving 1,500 questions. In actual, I solved 2,000 questions. What all could be the reasons? Either number of days is increased. I thought I'll work for 25 days, but in actual, I work for 28 days. Possible? Yes. Firstly, days can change. Second, I said, no, I studied for 25 days only. But what happened? I thought I'll study for 10 hours, right? I studied for more hours. I studied for 12 hours, 13 hours. So hours increased. That is the input hours. How many hours I'm studying, that increased. Or third, I studied for 25 days only. I studied for 10 hours per day only. But I improved my speed. I was way more efficient. I thought 10 minutes is required per question, but I took 8 minutes only per question, because of which I could solve more. So if the output has increased, it can be because of 3 reasons. Either day has changed, or the hours we are trying to work, that has changed, or the efficiency, the speed, the productivity, the output we are getting from the hours has changed. So volume variance, we are getting the difference between actual output and budgeted output. It can be because of 3 reasons. Firstly, calendar variance, that is the number of days has changed. Day. Capacity variance, it is the input hour based, how much capacity we are trying to utilize, how much of hours we are trying to work in. Or efficiency is the output hour based, how much productivity we are getting from the hours, what is the output we are getting. So why we are having calendar variance? Because budgeted working days is not equal to actual working days. We thought we'll be working for 25 days, but in actual we work for 26 days. Remember, the difference between budgeted overhead and actual overhead is already covered. So now throughout the multiplier will always be SRR only. So throughout the multiplier will be SRR. Here calendar variance, it is because of the difference in working days. So which is favorable? I estimated that I'll be working for 25 days, but in actual I work for 30 days. More days, more will be the output. Actual working days more than budgeted working days will be favorable. So how will we get the formula? It is actual working days minus budgeted working days. We get the difference in terms of days. 30 days minus 25 days, 5 days. Multiplier, yes, should be multiplied with SRR per day. Okay. Next, we have the capacity variance. It is based on input hours. How many hours we are working? Here it is happening because the actual hours is not equal to the budgeted hours for actual working days. Okay, we thought we were working for 25 days. Then in actual, we work for 26 days. So budgeted for 25 days, 250 hours was that. 26 days we actually work, 260 hours we should have worked. But in actual, we work for 270 hours. This 10 hours, we've exceeded our capacity. So budgeted hours for actual working days is not equal to the actual hours. Which is favorable? Actual hours more than budgeted hours for actual working days is favorable. I thought for the 26 days, I'll be working for 260 hours. But in actual, I work for 300 hours. So more the number of hours, more will be the question I can be solving. So it is actual hours minus budgeted hours for actual working days. We get the difference in terms of hours. So multiplier is SRR per hour. Here we get the difference in terms of days. So it is SRR per day. Here it is in terms of hours. So it is SRR per hour. Thirdly is efficiency. This was input hour. How many hours we are actually putting? This is output. From the hours, what is the output we are getting? Yes, I'm telling, actually I worked for 1000 hours. But from this 1000 hours, I've got an output which other people get by working for 1200 hours. I'm very efficient. So standard hour more than actual hour is favorable. I've actually worked only for 1000 hours, but from this 1000 hour, I've got an output which other people get from 1200 hours. So it is difference between standard hours and actual hours. It is standard hours minus actual hours. We get the difference in hours multiplied by SRR per hour. Yes, this is fixed overhead cost variance. Yes, firstly, we had the fixed overhead cost variance. Two reasons. Firstly, budgeted overhead not equal to actual overhead. It is the expenditure or budget variance. Secondly, budgeted output not equal to actual output. It is the volume variance. Volume variance, further analysis. Yes, calendar variance, it is based on the days. Capacity variance based on the input hours. Efficiency variance based on the output hours. What is the output we are getting? Yes. So there is a shortcut to have a look at all the fixed overhead cost variances. So the cost. So the shortcut is given here. So all in all, we have three different comparisons. Firstly, we have the standard and actual comparison. We are doing the standard and actual comparison. Fixed overhead cost variance. We are taking standard overhead, actual overhead. It is standard actual comparison. Then we have the last one, efficiency. Here we are comparing standard hours and actual hours. So here also we have standard actual comparison. So first and last will be standard actual comparison. So cost variance and efficiency variance, we are comparing standard versus actual. Next, expenditure variance or budget variance, we are comparing budget versus actual. Budget variance, here we are comparing budgeted overheads with actual overheads. It is cost based, it is budgeted overheads with actual overheads. So it is budget versus actual comparison is happening in expenditure variance. Every other variance is actual versus budget comparison. So in volume variance, it is actual output with budgeted output. Calendar variance, actual working days with budgeted working days. Capacity variance, it is the actual hours with the budgeted hours. Yes. So the shortcut is first and last variance, cost variance and efficiency variance is standard versus actual. Budget variance or expenditure variance is budget versus actual. All the remaining are actual versus budget comparison. So based on this, see how simple it becomes. So standard versus actual is cost and efficiency. Cost is the overall change. It is nothing but the standard overhead cost minus actual overhead cost. Now, Efficiency is output hour based. Again, it is standard versus actual comparison. It is hour based, standard versus actual. It is standard hours minus actual hours. We get the difference in hours to get value multiplied by SRR per hour. Next, we have budget versus actual comparison. Budget versus actual comparison is in budget variance or expenditure variance. What are we comparing? We are comparing the cost. So we are comparing budgeted cost, overhead cost with the actual overhead cost. This is the budget variance. Then we have actual versus budget comparison. So here we are doing actual minus budget. So volume variance, we are comparing the output. What is the actual output minus what is the budgeted output? We get the difference in units to get value multiplied by SRR per unit. Calendar variance, it is day based. What is the actual working day minus what is the budgeted working day? We get the difference in days to get value is multiplied with SRR per day. Then we have the capacity variance. Again, actual versus budget comparison is again actual hours. It is hour based minus budgeted hours for actual working days. We get the difference in hours to get value multiplied by SRR per hour. So one final revision of fixed overhead cost variance. All the names, fixed overhead cost variance, overall change. Two reasons. One is expenditure, that is cost change, and volume, that is output change. Volume variance, further analysis. Calendar, day based, capacity, input hour based, and efficiency, output hour based. Shortcut, first and last. Cost and efficiency is standard versus actual. Budget is budget versus actual, and the remaining are actual versus budget. So based on that, we can automatically develop all the formulas. With this, we've covered all different variances. We've covered material cost variance, labor cost variance, variable overhead cost variance, fixed overhead cost variance. Clear, students? How's the Josh? Should we continue with the next chapter, students? So we've done with 3 chapters. Cost sheet, cost accounting, standard costing is done. We have 2 more chapters, marginal costing and budgetary control. So are we ready? Believe me, students, it's 3 a.m. in the morning. It's 8th of December. So today you guys will be writing your law exam, and by today evening I've promised that part 3 of the revision will be uploaded. I wasn't keeping well from the past few days, had a cold cough, so could not record that. So today was the ultimatum, and it's 3 a.m. in the morning. I don't have an option, but it will all be worth it. If students prepare well, and if it will be of some use to the students, all these efforts, all these sleepless nights are worth it. Remember, even students, yes, all these sleepless nights will ultimately pay reward. So with this energy, let's move to the next chapter, marginal costing. Yes, let's go to the world of costing. Costing can be done for existing goods or services. It can be done for new goods or services. Existing goods or services, we have 2 objectives. First is cost ascertainment, one is cost control. For new goods or services, you're planning, so you want to do a decision making. And for decision making, we are using the technique of marginal costing. A very important chapter from an exam perspective. On an average, we have 11 marks from this chapter. Undoubtedly falls in the A+ category. So firstly, we'll be looking at the basic formulae, then we'll be looking at few special scenarios. So what is marginal cost? It is the change in cost due to the change in level of output. Suppose to manufacture 100 units, the cost was 7,000. When we manufactured 101 units, the cost is 7,050. So we are telling to manufacture this one extra unit, we are incurring a cost of 50 rupees. This is the marginal cost. There are few assumptions of marginal costing. Unless otherwise specified, selling price per unit is constant, variable cost per unit is constant, and total fixed cost is constant. Selling price and variable cost on per unit basis is constant, fixed cost on totality basis is constant. In marginal costing, we bifurcate the cost as a variable cost, fixed cost. Variable cost, when we are looking at the cost sheet, is what all are variable cost? Direct material, direct labor, direct expense always are variable. That is, a prime cost will always be variable. And the overheads, production overheads, administration overheads, selling and distribution overheads, they may be variable, they may be fixed. So overheads, we have the variable overheads, we have the fixed overhead. This is how we bifurcate the cost. So we are going to look at the basic formulas. Let us try to understand with the help of an example. Again, marginal costing is one ocean of a syllabus. We're trying to cover it in the next 30 minutes. So we'll be quickly trying to cover marginal costing. In marginal costing, the whole idea is we are bifurcating the cost as variable cost and fixed cost for the purpose of decision making. Suppose I am a manufacturer of pen. I've started a factory wherein I'm manufacturing this pen. So to set up the factory, for the employees, for machines, etc., fixed cost of 50,000 I've incurred. This is incurred irrespective of whether I sell the pen or not. So I record it separately. The fixed cost is 50,000. Next, now, so what happens every time I sell the pen, I'm getting 10 rupees. So for every sale, I'm getting 10 rupees. And to manufacture this pen so that I can sell it, I have to incur 6 rupees variable cost. So what is happening? 50,000 total cost I'm bifurcating. 50,000 I'm telling this I have to incur irrespective of whether I manufacture or not. So I keep it separate. Now what is happening actually? Every time I'm producing the goods, I'm producing a pen, I have to incur 6 rupees. I'm selling, I'm getting 10 rupees. So every time I'm selling 10 rupees, I'm getting 6 rupees is a cost I have to incur to produce. Net 4 rupees I'm saving for every pen manufactured. So this is the contribution, that is sales minus variable cost. Every time I'm selling a pen, I'm saving 4 rupees. Every time I'm selling a pen, 10 rupees is a sale, 6 rupees is a variable cost, 4 rupees I'm saving. This is contribution. Contribution is sales minus variable cost. Now, I want to calculate all these things as a percentage of sale. Yes. So I'm telling sale, how much is it as a percentage of sales? So out of 10 rupees, sales will always be 100% of sales. Now, variable cost I'm telling, yes, sales is 10 rupees. Out of this variable cost is 6 rupees. So as a percentage, it is 60%. So variable cost is 60% of sales. Contribution, sales is 10 rupees. Out of this, contribution is 4 rupees into 100. Contribution is 40%. These are variable cost ratio and PV ratio. Variable cost ratio is variable cost to sales into 100. PV ratio, profit volume ratio, is nothing but the ratio of contribution to sales. It is contribution divided by sales into 100. So we have two more formulas. We have variable cost ratio, that is variable cost divided by sales into 100. We have PV ratio, that is contribution divided by sales into 100. And one important relationship, both are complementary. That is the sum of both these ratio is 100. See, here variable cost ratio was 60%, PV ratio was 40%, the total was 100%. Suppose question tells variable cost ratio is 75%. We automatically know PV ratio is 25% because the total is 100%. Clear? Yes. Now, what next we have break-even point. What is break-even point? It is the point wherein there is no profit, no loss. That is the total cost is equal to total sales. See what is happening. I am a manufacturer of pen. Every pen I am selling, 10 rupees I am getting. Yes, for that variable cost, 6 rupees I have to incur. From every pen I am saying 4 rupees. From this I am absorbing my fixed cost. What is the fixed cost I have to absorb? 50,000. From every pen I am absorbing 4 rupees. So how many pens I have to sell so that I can absorb this 50,000? 50,000 I have to absorb, divided by, from every pen I am getting 4. So 50,000 divided by 4, it is 1,250 pen. So 50,000 divided by 4 is 12,500 pen. So I'm telling, if I manufacture and sell 12,500 pens, I will be reaching a point where there is no profit, no loss. This is break-even point in terms of units. So I'm telling how much fixed cost I want to absorb. Yes, what is the total contribution I want? I want total 50,000. Yes, from every unit, how much I'm getting? 4 rupee per unit. So fixed cost divided by contribution per unit, we get the break-even point in terms of units. Now, break-even point in terms of sale rupee value. We are telling, okay. So from every unit, we are getting 4 rupees. We need to sell so many units so that we can get a contribution of 50,000 rupees. So if you have a contribution of 50,000 rupees, from that we can absorb total 50,000 rupees. Okay. So contribution 50,000 is required. Now we want in terms of sale. We know total 50,000 contribution is required. Yes. Now we know contribution is 40% of sales. Okay. So we know sale is 100, contribution is 40% of sale, 40. Now we know the total contribution we want is 40,000. So what will be the sale? It is fixed cost or contribution required 40,000 divided by PV ratio, that is 40%. So we get 40,000 divided by 40%. We get BP in terms of sale value. That is fixed cost divided by PV ratio. How do we get BP? Break-even point is the point where there is no profit, no loss. That is the total cost is equal to total sales. BP in terms of units is fixed cost divided by contribution per unit. BP in terms of sale rupee is fixed cost divided by PV ratio. Next, margin of safety. Margin of safety means how much sales we've made over and above BP sales. Okay, I'm telling. Yes. So total I've made a sale of 5 lakh rupees. In that, for break even, to reach a position of no profit, no loss, I had to make a sale of 1.25. So over and above that, whatever is my sale is called as margin of safety sale. So what is margin of safety sale? It is the sale over and above the BP sale. I'm telling total sale is 5 lakh. Out of that, BP sale is 1.25 lakh. So therefore, 3.75 lakh is the margin of safety sale. So how do we get margin of safety sale? It is total sale minus BP sale. Clear. Now we have the BP sale ratio and MOS sale ratio. Total sale is 5 lakh. We want to see how much percent is BP sale, how much percent is MOS. So we are selling BP sale percentage is 1.25 lakh divided by 5 lakh, 25%. MOS sale is 3.75 lakh divided by 5 lakh. It is 75%. So how do we get it? MOS sale is the sale over BP sale, that is total sale minus BP sale. Now, how do we get it as percentage? BP sale percentage is BP sale divided by total sale into 100. MOS sale percentage is MOS sale divided by total sale into 100. Again, both these are complementary. That is the total of both is 1. Here it is 25%, it is 75%. The total of both is 100%, or in terms of decimal, it is 1. Now, calculation of contribution. So from the BP sale into PV ratio, we'll be getting the fixed cost. MOS sale into PV ratio will be getting the profit. Let us have a look at this with the help of an example. The same data, we are selling pen 10 rupee per unit, 6 rupees a variable cost, 4 rupees a contribution, 50,000 is the fixed cost. Now, BP is that state wherein profit is also not there, loss is also not there. So profit or loss is 0. Profit or loss is 0, but we have to absorb 50,000 fixed cost. So how much should be the contribution? We should be earning 50,000 rupees as contribution so that we can absorb 50,000 fixed cost. Profit or loss will be 0. Now, 50,000 is the contribution we want, and contribution is 40% of sales. So 50,000 divided by 40%, 1,25,000 will be the sales. Yes, so BP sale will be 1,25,000. So if we sell 1,25,000, 60% of this, that is 75,000, will be the variable cost. 50,000 will be contribution. From that, we recover 50,000 fixed cost. Profit or loss is 0. So BP sale into PV ratio, yes, 1,25,000 into 40%, yes, we'll be getting the fixed cost 50,000, which is nothing but the fixed cost. Yes. Now, all in all, what is the sale we have made? All in all, we've made a sale of 5 lakh rupees. Yes, from this variable cost is 60%, 3 lakh. We have a contribution of 2 lakh. From that, we reduce 50,000. We'll be arriving at a profit of 1,50,000. This is the total profit we are having. What is the margin of safety sale? BP sale is 1,25,000. Over and above that, 3,75,000 is a margin of safety sale. In margin of safety sale, what is the variable cost? 2,25,000 is a variable cost. Yes. What is the contribution? 1,50,000. What is the fixed cost? Fixed cost is 0 here because the entire fixed cost is already absorbed while we are selling BP. We had 50,000 fixed cost. So when we sold the BP unit, the entire fixed cost is absorbed. Now over and above that, whatever is the contribution we are earning, that is our profit. So this will be our profit. So BP sale into PV ratio will give us the contribution, which is nothing but the fixed cost. MOS sale into PV ratio will give us the contribution, which is nothing but our profit. So these are the two formulas. Yes, BP sale into PV ratio will give us the fixed cost. MOS sale into PV ratio will give us the profit. So magic box, we've looked at so many formulas till now. We've looked at contribution, we've looked at PV ratio, variable cost ratio, we've looked at break-even point, we've looked at margin of safety and all the related formulas. The one big thing in marginal costing is the formulas. We tend to forget the formulas and we won't be knowing at what time which formula to use. Yes, so we have a magic box here, which I call the formula creator. Yes, if we just know the logics without even knowing a single formula, we use this table, we'll be in a position to get every data whichever we want. Let us try seeing how this works. So for calculation, for every calculation, every kind of question having basic data, yes, this one should work. Yes, sales is 10 rupee, variable cost is 6, contribution per unit is 4, 50,000 is the total fixed cost. In terms of percentage, sale is 100%, variable cost is 60%, contribution is 40%. This is the basic data we should always be having, and wherever one is available, one is not available, will be filled. First, if we have to calculate BP, how do? We know at BP profit or loss is 0. So we begin from here. Okay, profit or loss is 0, but we have to absorb 50,000 fixed cost. So we have to be having a contribution of 50,000. Now, if you want BP in terms of units, see, look at the data here. Everything is visible here only. Yes, everything is visible here only. Look at this. So we are telling we want a contribution of 50,000, and from every unit we'll be getting 4 rupee, 4 rupee, 4 rupee as contribution. So how many unit we should sell? So 50,000 is what we want. From every unit we will be getting 4. 50,000 divided by 4 will be 12,500. Yes, that is BP in terms of number of units. Now, if you want BP sale value, we are telling we want a contribution of 50,000, and contribution is 40% of sales. So it is 50,000 divided by 40%. It will be 1,25,000 will be the sales. So we've got 1,25,000 is the sales. 60% of that, 75,000 is the cost. We've got the contribution, fixed cost, profit. We've got it in terms of units as well. Now we know the total sale is 5 lakh rupees. Okay, total sale is 5 lakh. 5 lakh sales from every unit we are getting 10 rupees. So how many units we should have sold? We should have sold 50,000 units. Okay, yes. Now 5 lakh is the total sales. So 1,25,000 is a BP sale. So what is the MOS sales? It is 3,75,000. Just logic, no need to by heart any formula. If you know the concept, every answer we can calculate on our own. Now, on totality basis, 5 lakh is a sales, 60% is a variable cost, that is 3 lakh is a variable cost. We have a contribution of 2 lakh. From a contribution of 2 lakh, on totality basis, for the year, we have 50,000 fixed cost, we'll be having a profit of 1.5 lakh. Now, this is 100%. Now we want to say BP percentage and MOS percentage. Yes. 5 lakh is the total sale, which is 100%. BP sale is 1,25,000. 1,25,000 on 5 lakh, it is 25%. So BP sale percentage is 25%. 3,75,000 on 5 lakh, it is 75%. In terms of units, total is 50,000, BP is 12,500, so it will be 37,500. Now if you want to calculate 37,500, 60% of it is 2,25,000. We'll be getting a contribution of 1,50,000. Yes, in MOS, the fixed cost is additional fixed cost is 0 because the total fixed cost is already absorbed in BP sales. So we'll be getting a profit of 1,50,000. So we've done every calculation without even by hurting anything. This is the simplest, easiest way to solve the sum. So formula creator, look at the data. We have to write particulars, sales minus variable cost, contribution minus fixed cost, profit or loss. Per unit percentages, always we have to write. Then depending on what data is there, what we want, we will be creating the table. Clear, students? Yes. Now, sales to earn desired profit. Yes, the formula is simple. See, so we've calculated BP. Yes, how did we calculate BP in terms of units if we want? Yes, how do we get? It is a desired contribution divided by contribution per unit. In BP, what is the contribution we want? We only want fixed cost. So it is fixed cost divided by contribution per unit. If you want in terms of sale value, it is fixed cost divided by PV ratio. Now we are telling it is not just BP. Yes, we don't just want to recover the fixed cost. Over and above that, we want to earn some profit. So we have to earn a bit more of contribution. So to earn desired profit, how do we get? It is fixed cost plus profit divided by contribution per unit. We get it in terms of number of units. Again, fixed cost plus profit divided by PV ratio. We get it in terms of sale value. This is the formula. Again, there is no need for us to look at the formula. Look at this. Suppose we are telling we want to earn a profit of say 1 lakh. So how much should be the sales? This is what we want to see. Yes, calculate sales to earn a profit of 1 lakh. So we are telling, okay, we want on totality basis 1 lakh rupees as profit. Okay. So we'll be having anyways 50,000 as fixed cost. Will anyways be having 50,000 as fixed cost. This anyways we have to absorb. Over and above that we want 1 lakh. So our contribution should be 1,50,000. If we are having 1,50,000 contribution, 50,000 will be fixed cost, 1 lakh will be the profit. Okay. So how did we get the contribution? It is nothing but fixed cost plus profit. Okay. Now we are compare. 1,50,000 is the contribution that we want, and we know contribution is 40% of sales. So what will be the sales? It is 1,50,000 divided by 40%. It is 3,75,000. So if sale is 3,75,000, 60% of it, 2,25,000 will be the variable cost. 1,50,000 will be the contribution. 50,000 is the fixed cost. Profit will be 1 lakh. How did we get it? Ultimately, we've got it without taking any formula, but ultimately what we have done, 1,50,000 divided by 40%. Yes. 1,50,000 is nothing but profit plus fixed cost. It is fixed cost plus profit divided by 40% is nothing but PV ratio. If we want in terms of units, so we are telling we want 1,50,000 contribution, and from every unit we are getting 4 rupees as contribution. So it is 1,50,000 divided by 4, 37,500 units. Again, what we did, fixed cost plus profit divided by contribution per unit, we get it in terms of number of units. Again, I'm telling you guys, there is no need to by heart any of the formulas. If you know the logic, we present everything in a tabular format. We'll be in a position to create all formulas ourselves. This will help us to get all answers. While we are doing, yes, write down the formula how we've got and do the answers. Yes, students. So with this, all the basics are done. Contribution, variable cost ratio, PV ratio, BP sales. We've also calculated margin of safety sales. We also looked at the sales to earn the desired profit. These were the basics of marginal costing. Now let's have a look at 5 special areas. Firstly, we have cash break-even point, cash BP. So till now we are telling we had 50,000 fixed cost. To recover that, how much you have to sell. Now we are telling in this 50,000 fixed cost, we have non-cash fixed cost, that is depreciation of 20,000. So others, that is cash fixed cost, is only 30,000. Now we are telling cash BP, we are telling to recover this cash fixed cost, how much we have to sell. So normally what we did, it was fixed cost divided by contribution per unit or PV ratio. For cash BP, we will be taking cash fixed cost divided by contribution per unit or PV ratio. This is cash break-even point. Next, graphical representation of break-even point. Not that important from an exam perspective, but still let's quickly have a look. Yes. So firstly, we have the sales. This is the sales line. This is the sales. Yes. As against that, this is the variable cost. Sales minus variable cost. This entire difference is the contribution. This entire difference is the contribution. Here, now, we've shown sales, we've shown variable cost. This is our fixed cost. Yes, this is our total cost. Yes, all lines we should draw. Now let us try analyzing. Yes, This is sales, this is variable cost, the difference is contribution. Now, this is the point at which this is the sales line, this is the total cost line, both meet. So this point is break-even point. If you bring it here, this is in terms of units, we get BP in terms of units. This is in terms of rupee, here we get BP in terms of rupees. Yes. Now, this is the sales, this is the total cost. Cost is more than sales. This is a loss area. This is the sales, this is the total cost, this is the profit region. Not asked in the examination, but still we are trying to cover everything so that students have everything in the limited time. Next, we have the differential formulas. Yes, what are these differential formulas? Suppose to manufacture one pen, sales is 10 rupees, variable cost is 6 rupees, contribution is 4 rupees, fixed cost is 50,000. If we manufacture 50,000 pens, it is 5 lakh, 3 lakh, 2 lakh is a contribution, 50,000 is a fixed cost, profit is 1,50,000. The total cost will be 50,000 fixed cost, 3 lakh variable cost, 3 lakh. If we are manufacturing 1 lakh also, similarly we have done on calculation. What is the difference? Difference in sales is 5 lakh. Difference in variable cost 3 lakh to 6 lakh is 3 lakh. Difference in contribution 4 lakh and 2 lakh is 2 lakh. Difference in fixed cost is 0. Difference in profit 1,50,000 to 3,50,000, 2 lakh. Difference in total cost 3,50,000 to 6,50,000, 3 lakh. Two important observations. The change in variable cost is equal to the change in total cost. Change in variable cost is also 3 lakh. Change in total cost is also 3 lakh. Why? Because change in fixed cost is 0. One more. Change in contribution is equal to the change in profit. Why? Again, because change in fixed cost is 0. So two important observations. Change in total cost is the change in variable cost. Change in contribution is the change in profit. Now, we have looked at variable cost ratio and PV ratio. Variable cost is variable cost upon sale into 100. PV ratio is contribution upon sale into 100. Yes. Variable cost is 6 upon 10, 60%. PV ratio is 4 upon 10, 40%. Now, variable cost ratio and PV ratio. Variable cost ratio, can I also write, instead of variable cost by sale, I will write it as difference in variable cost divided by difference in sales in 100. I will be getting the same thing. Difference in variable cost, it is 3 lakh divided by difference in sale 5 lakh. Again, I'll be getting 3 lakh divided by 5 lakh is again 60%. Yes, here difference in contribution divided by difference in sale. Again, difference in contribution is 2 lakh, difference in sale is 5 lakh. Again, it is 40%. Variable cost ratio we have written it as difference in variable cost divided by difference in sale into 100. PV ratio we have written it as difference in contribution divided by difference in sales into 100. We've already discussed difference in variable cost is equal to the difference in total cost because change in fixed cost is 0. So we'll also write it as it is difference in total cost divided by difference in sales into 100. That is variable cost ratio. Coming to PV ratio, instead of difference in contribution, we'll be writing it as difference in profit. Again, because difference in fixed cost is 0. So it is difference in fixed cost divided by, so it is difference in profit divided by difference in sales into 100. So we have the differential formula. Variable cost ratio is difference in total cost divided by difference in sales into 100. PV ratio is difference in profit divided by difference in sales into 100. Clear, students? We have another area, multi-product break-even point. Very important from exam perspective. Suppose we are a company which sells mobile as well as laptop. Yes, mobile we are selling for 10,000, variable cost is 5,000, contribution is 5,000, PV ratio is 50%. Laptop 50,000 we are selling, 40,000 is a variable cost, 10,000 is a contribution. Our total fixed cost is 10 lakh rupees. Till now, calculation of BP, everything was simple. We are telling, okay, suppose we are selling only mobile. We are telling total 10 lakh we have to absorb. From every unit we are absorbing 5,000, 5,000. So how many units we have to sell? Yes, but now what is happening? We are selling mobile also, we are selling laptop also. So this 10 lakh we have to absorb, but we are absorbing from mobile also, we are absorbing from laptop also. What is the sales ratio, sales mix? We are selling in the ratio 2:1. So how sales are actually happening? if I'm selling 2 mobiles, I'll be selling 1 laptop. This is how my sales are actually happening in the ratio 2:1. Now, if I have to calculate BP in terms of units, BP in terms of sale value, BP in terms of sale quantity, that is units, and BP in terms of sale value. Till now, the normal formula, what we have seen, BP in terms of quantity is fixed cost divided by contribution per unit. BP in terms of sale rupee is fixed cost divided by PV ratio. Now, what we have to do is, it will be the same formula, fixed cost divided by, here it was contribution per unit because we are selling only 1 unit. Now we are selling more than 1 unit. So we'll be calculating contribution per composite unit. Here it was fixed cost divided by PV ratio. We are selling only 1 unit. We calculated the PV ratio. We have more than 1 unit. We'll be calculating what is the composite PV ratio. We do that, we get BP in terms of quantity and sale value. Let us try understanding it. Firstly, calculation of BP in terms of units. We'll try explaining it quickly. Instead of contribution per unit, we want contribution per composite unit. We have mobile, laptop. How are we selling? When we are selling 2 mobile, we are selling 1 laptop. From mobile, we are having a contribution of 5,000. From laptop, we are having a contribution of 10,000. Now we are telling composite. We are selling them together. So we are calculating a new composite unit. We are telling if we are selling 1 unit, then how much will be mobile, how much will be laptop? If we are selling 3 unit, then 2 will be mobile, 1 will be laptop. So we are telling if we are selling only 1 unit, then so we'll tell, okay, then 2/3 will be mobile, 1/3 will be laptop. That is the ratio. So now what will be the contribution? Yes, in the composite unit. So 5,000 rupees from mobile when we are selling 1 mobile, but we are only selling 2/3. So 5,000 into 2 by 3, 3,333. Yes. 10,000 if we sell the whole laptop, but we are only selling 1/3. Yes. So 10,000 into 1 by 3, 3,333. So if we sell 1 composite unit, we'll be getting 6,666. In this 1 composite unit, what all will be there? We'll be having 2/3 mobile plus 1/3 laptop. So what are all the steps we have taken? Firstly, we've calculated the contribution per unit. Then we've given weight based on the sale quantity, based on the number of unit. Yes, here we've given 2:1, so we've given 2 by 3 and 1 by 3. Based on that, we've calculated the composite contribution per composite unit. It is nothing but contribution per unit into weight. The total of that is the total of contribution per unit into weights. So we are telling if we sell 1 bundle, we'll be getting 6,666.66. In this 1 bundle, we'll be having 2/3 mobile and 1/3 laptop. Now we want to absorb a total of 10 lakh. So how many such bundles we have to sell? It is 10 lakh divided by 6,666.66. So we'll be getting the total bundles to be sold. So let's look at the steps. What all we have to do? Firstly, to calculate BP in terms of quantity, firstly, we calculate the contribution per unit individual. Then we calculate the contribution per composite unit. How do we get? It is the total of contribution per unit into weight. What is the weight? Where weight is the ratio of the sale quantity. Most important, ratio of the sale quantity. We've calculated contribution per composite unit. Now we calculate the BP. It is fixed cost divided by contribution per composite unit. We tell 10 lakh we won't divide by 6,666.66 for every composite unit. We get it as 150 composite units. So we are telling if we sell 150 composite units, we will be in a position to absorb our full fixed cost. Yes. Now, but in actual, we are not selling composite unit. In actual, we are only selling mobile and laptop. So we are telling yes. So every composite unit will be having 2/3 mobile, 1/3 laptop. So 150 into 2/3, that is 100 mobile and 50 laptop we are actually selling. So if we sell 100 mobile and 50 laptop, we'll be arriving at our break-even point. Yes. So look at the steps. In case of multi-product BP, wherein we want BP in terms of quantity, it is fixed cost divided by contribution per composite. First, we'll calculate the contribution per unit for every product. Then we'll calculate the contribution per composite unit. How do we do? It is the total of contribution per unit into weight. We want BP in terms of sale quantity, so we'll be taking the weight as a ratio of sale quantity. Yes. So when we do that, we get the contribution per composite unit, fixed cost divided by contribution per composite unit, we get the composite units to be sold. Yes. Now again we split. Yes. The split will again be in the ratio of sale quantity. So here, wherein we want multi-product BP in terms of quantity, everywhere we'll be taking, wherever ratio we'll be taking will be the ratio of sales quantity. Clear? Now, if we want multi-product BP in terms of sale value. Yes, we want in terms of sale value. So simple logic, everywhere we are taking the ratio, everywhere we are taking weight, the weight will be on the basis of sale value. Here, everywhere we have taken based on sale quantity. Here, everywhere will be taking based on sale value. As simple as that. So we'll try telling with the help of a small example. Yes, BP in terms of sale value. Formula is fixed cost divided by PV ratio. Here it is composite PV ratio. What does PV ratio tell? Yes, PV ratio of 0.4. What is its meaning? It is telling if my sale is 1 rupee, then my contribution is 0.4 rupees. So whenever we are distributing, we have to distribute on the basis of the sale value. Yes, I'm selling 2 mobile and 1 laptop. Total I'm selling 3 units. Yes. So for mobile, selling price is 10,000, laptop it is 50,000. Contribution per unit is 5,000 and 10,000. PV ratio individually is 50% and 20%. Now see, yes, when I'm selling, I'll be selling 2 mobile and 1 laptop. So when I'm selling 2 mobile, it is 10,000 into 2, 20,000 sale value. 1 laptop, 50,000 into 1, 50,000. So the total sale value will be 70,000. Yes. Contribution, I'll be selling 2 mobile, 5,000 per mobile into 2 mobile, 10,000. 10,000 per laptop into 1 laptop, 10,000. Totally, I'll be getting 20,000 contribution. So now what is my PV ratio, composite PV ratio? Yes, it is 20,000 divided by 70,000. It is 28.57%. This 28.57% we can get if we take PV ratio into weight of sale value. What is the weight of sale value? Yes, sale value is 20,000 and 50,000. So here the ratio is 2/7. Here it is 5/7. So composite PV ratio, 50% into 2/7, we get it as 0.1428. Here 20% into 5/7, we get it as 0.1428. Total we get 0.2857. That is 28.57. So what is the steps we have to take if in case we want to calculate BP in terms of sale rupee? Yes. Firstly, individually calculate PV ratio, step number 1. Second, we have to calculate the composite PV ratio. How do we get composite PV ratio? It is nothing but the total of PV ratio into weights, wherein weight will be taking the ratio of sale value. Yes. So when we do that, now we've got the composite PV ratio, fixed cost divided by composite PV ratio, we get the BP sale. So we are telling, if totally 35 lakh sales we are doing, we will be arriving at breakeven. We want sales of individually. What is the sale of mobile? What is the sale of laptop? Now, this 35 lakh sales, we have to split it between mobile and laptop. Again, the split will be in the ratio of sales value. If I have to summarize the entire multi-product BP, BP in terms of sale quantity, BP in terms of sale value. Sale quantity is fixed cost divided by contribution per composite unit. Sale value is fixed cost divided by composite PV ratio. Yes. So when we are taking the weight as well as when we are splitting, if it is in terms of sale quantity, we'll be taking the ratio of sale quantity. If it is in terms of sale value, we'll be taking the ratio of sale value. Single line. Yes, we'll be in a position to solve multi-product BP. Multi-product BP is very important from an exam perspective. Next, we have limiting factor. What is limiting factor? Limiting factor is when the resource available is less than the resource required. Suppose we are manufacturing mobile and laptop. The total labor hours available with us is 30,000 hours. the demand for mobile is 30,000, for laptop is 20,000. For every unit, we want 1 hour and 3 hours. So to manufacture, to fulfill the demand of mobile, 30,000 into 1 hour, 30,000 hours is required. To fulfill the demand of laptop, 20,000 into 3, 60,000 hours is required. Altogether, 90,000 hours is required. But I have available with me only 30,000. Resources available is less, so it is called as limiting factor. So what do we do in case of limiting factor? First, we calculate what is the contribution per unit. In case of mobile, it was 5,000, laptop, it is 10,000. Then we calculate what is the contribution per limiting factor. Here, the limiting factor is hour, so we calculate the contribution per hour. We tell, okay, in case of mobile, we are earning a contribution of 5,000. But to earn this contribution of 5,000, yes, our employee will have to work for 1 hour. So for every hour employee is working, we are getting a contribution of 5,000. Here, yes, we are telling by selling a laptop, we are getting 10,000, agreed. But to sell this laptop, employee should work for 3 hours. So for every hour employee is working, we are getting 3,333.3. This is nothing but contribution per unit divided by limiting factor per unit. So we get the contribution per limiting factor. Now we give the ranking. We tell here it is 5,000. If it is mobile, it is 3,333 per hour. It is laptop. We tell mobile is better. So first priority we give to mobile. First we try manufacturing maximum mobile. Then we try manufacturing the laptop. Yes. So the simple steps in case of limiting factor. First, check if the factor is a limiting factor. When it is limiting factor, when the resources available is less than the resource required. Yes. If it is limiting factor, then what are the steps to be followed? First, calculate the contribution per unit. Calculate it. Next, calculate the contribution per limiting factor. How do we get it? It is nothing but contribution per unit divided by limiting factor per unit. We get the contribution per limiting. Next, we'll be ranking the different products based on contribution per limiting factor. Whichever is the first rank, we try to allocate more resources, then go on in that rank. So we'll be allocating resources based on the ranking so made. Clear, students? We have final 2 topics in this chapter. Next topic is cost break-even point or cost indifference point. It is the point at which cost as per 2 different alternatives is the same. Small example, we are trying to take a decision whether to buy electric vehicle or to buy a conventional petrol diesel vehicle. So what are the factors we'll be looking? To buy the vehicle, what is the cost, fixed cost we are incurring? And for running, what is the cost we are incurring per kilometer? To buy electric vehicle is slightly expensive. So we have to pay 10 lakh for electric vehicle, but the conventional vehicle will be getting for 7 lakh. So in terms of fixed cost, the difference is 3 lakh. Variable cost. Electric vehicle, for every kilometer, we have to incur 10 rupee per kilometer. Conventional vehicle, we have to incur 20 rupee per kilometer. So if we resort to electric vehicle, we'll be saving 10 rupee per kilometer. So now, how do we take a decision? Yes, we tell, see, initially we are traveling very less. Yes, forget the environmental factor. We are traveling very less. We tell conventional vehicle is better because the upfront fixed cost is less, so the total cost will be less. We are traveling so much, so we'll be telling electric vehicle is better because overall the variable cost is less. So what is that point based on which we make this bifurcation? That point is called as cost indifference point or cost break-even point. This is the point at which cost as per both the alternatives is same. They're telling at this point, whether we use electric vehicle or conventional vehicle, it will be the same. How do we get? It is nothing but difference in fixed cost divided by difference in variable cost. We tell in electric vehicle, we are having a disadvantage of 3 lakh. But for every kilometer, we are saving 10 rupee, 10 rupee, 10 rupee, 10 rupee. So 3 lakh divided by 10 rupee, it is 30,000 kilometers. So we are telling if we run 30,000 kilometers, then whether we use conventional vehicle or new vehicle, the total cost will be same. If we are using less than 30,000 kilometers, we are using very less. We will tell conventional vehicle is better because the fixed cost is less. We are using more than 30,000 kilometers. We are using so much more. We are telling electric vehicle is better because the variable cost is less. Clear? This is cost indifference point. Cost BP or cost indifference point, will be getting it as difference in fixed cost divided by difference in variable cost. Now, let us try understanding this with the help of a graph. We'll be getting a better idea. For electric vehicle, we told for electric vehicle, we have a fixed cost of 10 lakh. Yes, over and above that, we have the variable cost. So this will be our total cost. Yes. Now, for conventional vehicle, 7 lakh is a fixed cost. Over and above that, we have a variable cost. So this is the total cost. This is how our total cost will look for the conventional vehicle. So this is the point at which cost as per both the alternatives is same. If it is below this, we tell conventional vehicle is better because we have a lower fixed cost that has a benefit here. If it is above this, we tell electric vehicle is better because the variable cost is less. So how decision making happens? This is the cost break-even point. Below that, alternate with the lower fixed cost is better. Above that, alternate with lower variable cost is better. This is how decision making is done. Yes. So this is cost indifference point. Now, an important thing, if we have more than two alternatives, suppose we have petrol vehicle, diesel vehicle and electric vehicle. So we are telling in petrol vehicle, the fixed cost is 7 lakh, diesel vehicle it is 8 lakh, slightly more. Yes, electric vehicle it is 10 lakh. Variable cost for petrol car, it is 30 rupees per kilometer, very high. Diesel car 20, slightly less. Electric car even lower, 10. So we have three different alternatives. Now, how do we calculate cost break even? When it was 2, we directly did it is difference in fixed cost divided by difference in variable cost. Now, we have to take a pair of two and calculate what will be the cost break even. First, we see petrol and diesel. So we see at what point the total cost for petrol and diesel will be same. So we take petrol and diesel, we calculated the cost BP, it came to 10,000 kilometers. Yes. Then we take diesel and electric. We've got it as 20,000 kilometers. Then we have taken petrol and electric, we've got it as 15,000 kilometers. So when we have three alternatives, take a pair of two, calculate individually cost BP. Now, decision making. How decision making will happen? Suppose we are running for very few kilometers. We are using the vehicle very less. Which would be better? We'll tell petrol vehicle is better because the fixed cost is less. We are using it too much. Then we'll tell electric is a vehicle. Then we'll tell electric vehicle is better because the variable cost is less. And in between that, we'll be telling diesel. Yes. So decision making, if you are traveling for very less kilometer, then we'll tell petrol because low fixed cost. If you're traveling for very high kilometer, we'll be telling electric vehicle because low variable cost. In between this, we'll be having diesel. So we draw a line wherein we have three different columns. Yes. If you are traveling very less, we tell petrol is better. If you're traveling too much, we tell electric is better. In between, we tell diesel is better. Now, what are these points that we have to see? Now we have to compare petrol and diesel. So what is the cost BP between petrol and diesel? It is 10,000 kilometers. So here it is 10,000 kilometers. So what is it telling? Up to 10,000 kilometers, from 0 to 10,000 kilometers, petrol is better. But if it is more than 10,000, diesel is better. Now we have to compare diesel and electric. What is the comparison between diesel and electric? 20,000. So we are telling, see, from 10,000 to 20,000, diesel is better. But if it is more than 20,000, electric is better. So this is how decision making is done. So when we have three alternatives, take a pair of two to calculate cost BP. Next, at the first, we'll be having alternate with lowest fixed cost. At the end, we'll be having alternate with lowest variable cost. In between, we'll be having the third alternate. Then we take a pair of two to whatever is the cost BP, we put the units. That is how decision is made. Clear, students? Now we have the final topic of this chapter, that is marginal versus absorption costing. Yes. So these are the two different approaches to costing when we use what is it, how profit will vary. Let us understand. Absorption costing, it is an approach to costing wherein all production costs are treated as product cost. What happens in marginal costing? Only variable production cost will be treated as product cost. In marginal costing, we don't have any respect for fixed cost. Yes, so if we have fixed production cost, we will not treat it as product cost. So what happens to fixed production cost? In absorption costing, we are treating it as product cost. It is the cost for the product. In marginal costing, we are telling it is not a cost incurred for the product. In marginal costing, we are telling fixed cost is incurred for the period. For the product, every time we are incurring only the variable cost. So here, this is treated as period cost. Yes. So what does it tell? What is its implication? Let us understand. So analysis of cost on functions. We have three functions. Firstly, in the factory, we have production. Then in the office, we have administration. And third, marketing, that is selling and distribution. In the factory, what are all the costs we are going to incur? We will be incurring direct material cost, direct labor cost, direct expense. We get the prime cost and factory overheads. Factory overheads may be variable or fixed. So we get the factory cost. Yes, which can also be called as the production cost as well. Yes. Then for administration, we have administration overheads. They may be variable or fixed. Selling and distribution overheads can also be variable or fixed. Yes. This cost is incurred for production. So this is the production cost. Administration and selling and distribution, it is not for production. So this is the non-production cost. Yes. So we have production cost, that is direct material, direct labor, direct expense, and factory overheads. Then we have the non-production cost, administration overheads, and selling and distribution overheads. Okay. What marginal costing tells? Only variable production cost will be treated as the product cost. Only variable production cost. What absorption costing tells? Yes, we'll be taking the total production cost. Whether it is variable, fixed does not matter. So if we have to value the product as per marginal costing, production cost, direct material, direct labor, direct expense, variable factory overhead, fixed factory overheads. But marginal tells we'll consider only the variable production cost. So we'll be valuing it based on direct material, direct labor, direct expense plus variable factory overhead. Absorption, the total production cost, that is direct material plus direct labor plus direct expense plus variable factory overhead plus fixed factory overhead. This is the difference. This is there in absorption, it is not there in margin. No. Non-production. Now, non-production cost. In marginal, we bifurcate the cost as a variable cost and fixed cost. Because sales minus variable cost, we calculate what is the contribution. From that, we reduce fixed cost and arrive at the profit. In absorption, that is not done. Directly, we reduce the total cost. So, even for the non-production cost, in marginal, we have to bifurcate the cost as a variable cost and fixed cost. But in absorption, such bifurcation is not true. It is not a production cost. On totality basis will be right. Yes. So this is the difference. So just to give you a gist in a minute. Yes, we have three functions. One is factory, wherein goods are produced. Then we have administration, selling, and distribution. Factory, yes, direct material, direct labor, direct expense, factory overheads gives us the factory cost or the production cost. The other cost are non-production cost. In marginal, only the variable production cost is considered. In absorption, the total production cost is considered. For the non-production cost, in marginal, we bifurcate the cost as variable and fixed. In absorption, such bifurcation is not done. So what is happening? What is the product cost? In case of absorption, the product cost is direct material, direct labor, direct expense, variable factory overhead, and fixed factory overhead. This gives us the product cost. But in marginal, we only take the variable production cost as the product cost, that is direct material, direct labor, direct expense, and variable factory overhead. This will be the product cost. Clear, students? So based on this, we have to prepare a profitability statement as per marginal costing. Firstly, We compare sales, marginal costing. What is the format? Sales minus variable cost, contribution minus fixed cost is profit or loss. So we have sales. From sales, we reduce the variable cost, we arrive at contribution. We reduce fixed cost, we arrive at the profit or loss. Yes. Now, variable cost. What all are the variable costs? Firstly, we have the variable production cost, variable product cost. This is nothing but the cost of goods sold. Why is it cost of goods sold? Suppose we have produced 1000 units, we have sold only 900 units. Here we are showing sales of 900 units. So here the cost should also be shown only for 900 units. Even if you have produced for 1000 units, to get the profit or loss, here the cost should be shown only for 900 units. Yes. So the cost of goods sold. How do we get? Yes. We had opening stock of 100. We have produced 1000. So total we have 1100. From that closing stock is 200. So units sold is only 900. So how do we get the cost of goods sold? It is the cost of opening stock plus cost of production minus the cost of closing stock. Yes. Then what all other variable cost we have? We have production cost, non-production cost. Production cost, the product cost we have already shown. Non-production cost, we have administration overhead and selling and distribution overhead. There also we will be having the variable portion. So we have variable admin overhead, variable selling and distribution overheads. The total variable cost we have taken, we have reduced, we have arrived at contribution. From contribution, we have to reduce fixed cost. Where all we have fixed cost? For producing the goods in factory, we have the fixed factory overheads. Non-production, we have the fixed admin overheads, fixed selling and distribution overheads. We have reduced the total fixed cost. We have arrived at profit or loss. This is profitability statement as per marginal costing. Now we have profitability statement as per absorption costing. In absorption costing, bifurcation between variable cost and fixed cost is not required. What we are doing? We're telling sales. From that, we reduce the total cost. We will be arriving at profit or loss. Okay. So now first, we have taken sale. Yes, we have taken sale for 900 units. Okay. So the cost, product cost should also be taken for the goods sold. So firstly, we have the product cost. That is the cost of goods sold. How will we be getting? It is again opening stock plus cost of production minus cost of closing stock. So we've got the production cost. Production cost. We've taken the total production cost for the goods sold. Now we have the non-production cost. In absorption, we have the administration overhead, selling and distribution overheads. Whether variable or fixed does not matter. So we have here variable and fixed administration overheads, variable and fixed selling and distribution overheads. Yes. Next, one item that we have is under absorption or over absorption. In marginal costing, there is no concept of under or over absorption because the fixed overheads, we are just charging for the period. We are not absorbing. But in case of absorption costing, we are absorbing, we are charging it to the product on an estimated basis. So under or over absorption may arise. So if we have under absorption, it will be added to the cost. If we have over absorption, it will be reduced from the cost. Under absorption, the cost incurred is 2,50,000, but we have absorbed only 2 lakh rupees. Yes. So here in the product cost, we've only shown 2 lakh rupees, but actually is 2,50,000. So the under absorption will be added to the cost. Yes, that is how we arrive at the total actual overheads. Over absorption, 2,50,000 is the overhead incurred, but we've absorbed more. We've absorbed 3 lakh. Here we have absorbed 3 lakh. 3 lakh is shown. So the over absorption, if we reduce 50,000, we will be arriving at the cost incurred. So under absorption will be added to the cost. Over absorption will be reduced from the cost. This is how we will be preparing profitability statement as per absorption costing. Remember the logic. Remember the basics. We have production cost. We have non-production cost. In marginal, the production cost, only variable production cost is taken. In absorption, the total production cost is taken. Non-production cost, administration overhead, selling and distribution overheads. In marginal, we need to bifurcate between variable cost and fixed cost. In absorption, that is not required. Yes. Now, we have a reconciliation of profit between absorption and margin. Yes. So the reason for difference in profit is because of the stock valuation. Valuation of stock, that is opening stock and closing stock. In absorption costing, stock is valued based on the total production cost. That is direct material, direct labor, direct expense, variable factory overheads, and fixed factory overheads. But in marginal costing, it is valued based on variable production cost. That is direct material, direct labor, direct expense, and variable factory overheads. So this is the difference. And because of difference in the value of stock, profit as per marginal costing and profit as per absorption costing will be different. If question asks us to prepare a reconciliation statement between marginal and absorption, first calculate profit as per one approach. Suppose we have calculated profit as per marginal, then the difference in profit is only because of the difference in stock valuation. See what is the difference in opening stock, what is the difference in closing stock. We'll be arriving at profit as per the other approach. Yes. So with this, the entire chapter of marginal costing is over. Few small adjustments. Firstly, calculation of opportunity cost. What is opportunity cost? It is the cost of next best alternative for one. Suppose I can manufacture either product A, product B, or product C. Yes, if I manufacture, contribution I'm getting from product A is 100, B is 80, C is 75. Yes. Suppose I decide to manufacture product A. What I have to sacrifice? I cannot manufacture product B, I cannot manufacture product C. So these both I have to sacrifice. Yes. What is the next best alternative? If I don't manufacture A, what was the next best alternative for me? I would have manufactured B. So the opportunity cost I'm losing is 80. Suppose I decide to manufacture B. So I'm manufacturing this. What is the next best alternative I've lost? Yes, I could have manufactured A or C. What is the best alternative I've missed out? A. So the opportunity cost will be 100. Yes, this is opportunity cost, the cost of next best alternative for them. Next, number of units produced and sold. Suppose we want to calculate what is the total sales. We want to calculate contribution. We know the contribution per unit. Into number of units we have to do. Should we take the number of units produced? Should we take the number of units sold? Yes. It will be lower of demand or production capacity. Yes. Look at the first scenario. For our product, we are manufacturing pen. We have a demand of 4,000 units. Yes. We can manufacture 5,000 units. Demand is only 4,000. Yes. What is the point manufacturing 5,000? So we'll tell, okay, we'll manufacture only 4,000. So it is lower of demand or production capacity. Second scenario, there is a demand of 10,000 pen, but we can manufacture only 7,000. Our capacity is only 7,000. So we tell, even though we have a demand, we can manufacture only 7,000. So the number of units produced and sold will be lower of demand and production capacity. Thirdly, closing stock valuation, where we have done the question of profit as per absorption and marginal costing. If nothing is given in the question, closing stock will be valued based on FIFO basis. Yes, so these were the small important adjustments which we may require while solving the questions. With this, marginal costing chapter is also done. So we have done the chapter cost sheet, cost accounting, standard costing, marginal costing. We have one final chapter pending, students. We have the final chapter, budgetary control, pending. Everyone excited? So now let's move to the final chapter, budgetary control. Budgetary control, on an average, we have 6 marks from this chapter. There are attempts wherein questions of 10 marks have also appeared. This chapter falls in the B category. One of the easiest and scoring chapters. We have 3 areas. First is fixed and flexible budget. Next, we have different functional budgets. Thirdly, we have the budget or the activity ratios. Firstly, the basics. What is budget? It is nothing but a financial or quantitative estimate of the future period. For the future period, I'm estimating. In the future period, this will be my sales. This will be my production. This will be my profit. That itself is budget. What is budgetary control? It is a system of managerial control through budget. So if you have a period, at the start of the period, we prepare a budget telling this will be the course of action for the future period. So at the start of the period, we prepare a budget. And at the end of it, we try seeing this was the budget prepared. This is the actual. Why is there a difference? So we exercise managerial control. We'll be having budgetary control. So first concept, we have fixed and flexible budget. What is fixed budget? It is a budget prepared at a fixed level of activity for a single level of activity. Suppose for the next year, I'm selling 500 units. This will be my cost. This will be my sales. This is the profit. Yes, once it is prepared, it is not changed even if the activity changes. What is a flexible budget? It is a budget prepared for varying level of activities, for different level of activities. If I'm manufacturing 500 units, this is how it will. If I'm manufacturing 600, this is how it will. If I'm manufacturing 800, if I'm manufacturing 1000, this is how the cost will be. This is how the sales will be. This is how the profit will be. This is what a flexible budget is. How do we prepare a flexible budget? For preparing flexible budget, the marginal costing technique of bifurcating the cost between fixed cost, variable cost, and semi-variable cost is important. So what we'll be doing is, suppose question has given us telling that if we are manufacturing 10,000 units, that is at our 100% capacity. So we have variable cost of 1 lakh, fixed cost of 5 lakh, and semi-variable cost of 6 lakh. All in all, we'll be incurring the cost of 12 lakh. So now we have to see if we are planning to manufacture 11,000 units, it is 110% of activity. Then what would be the case? We'll tell variable cost keeps varying based on the change in activity. So for 10,000 units, if it was 1 lakh, for 11,000 units, it will be 1 lakh 10,000. Fixed cost, it does not change irrespective of change in activity. We'll tell whether it is 10,000, 11,000, whatever it is, it will remain the same 5 lakh. Semi-variable cost, question will it's semi-variable cost, question will itself specify telling how semi-variable cost will change. Question may tell when the activity increases by 10%, semi-variable cost increases by 5%. So 6 lakh plus 5%, it is 30,000. So 6 lakh 30,000. So we have the total cost 6, 5, 11, 12 lakh 40,000. Clear? This is how flexible budgets are prepared. So in flexible budget, at different level of activity, we prepare different budgets. For different level, this will be the sales, this will be the cost, this will be the profit or loss. In cost, what is the variable cost, fixed cost, semi-variable cost? Yes. The most important area for preparation of flexible budget is bifurcation of cost between variable cost, fixed cost, and semi-variable cost. What is variable cost? It is the cost which varies with the level of output. So output changes, cost also changes. What is fixed cost? It is the cost which does not vary with the level of output. Irrespective of change in output, the cost will remain the same. What is semi-variable? It varies, but not proportionately. There is a change, but not proportionately like variable cost. Yes. What is a peculiar feature? In case of variable cost, for every unit increase, cost increases. So the cost per unit will be the same. Suppose question is telling for 100 units, the cost is 500. For 200 units, cost is 1000. This is variable cost because at 100 units also, our cost per unit was 5. At 200 units also, cost per unit is 5. So variable cost per unit will be constant. In case of fixed cost, the total cost will be constant. On totality basis, it will be constant. Say for 100 units, it is 1 lakh rupees in total. For 200 units also, it is 1 lakh in total. So in case of fixed cost, in totality basis, it will be constant. Semi-variable cost, on totality basis also, it will not be constant. On per unit basis also, it will not be constant. See, for 100 units, the cost is 10,000. When it rises to 200 units, cost increases by 30%, say for example. So it becomes 13,000. So for 100 unit, cost per unit is 100. At 200 unit, cost per unit is 65. On totality basis also, it is not the same. On per unit basis also, it is not the same. This is semi-variable cost. Now, how do we identify in the question whether the cost is variable cost, fixed cost, or semi-variable cost? For variable cost, if question is telling direct material, direct labor, direct expense, variable overheads, they are always variable. Next, if question is specifically telling that this cost is a variable cost, then we'll treat it as variable cost. Or if amount is given as a percentage of sales, suppose question is telling commission for salesman is 10% of sales. So if the sale is 100 rupees, 10 rupees, sale is 200 rupees, 20 rupees, sale is 500 rupees, 50 rupees, 10% of that. So as and when the sales increases, activity increases, the cost increases. This will be also variable cost. So how do we identify fixed cost? If question specifically tells that it is a fixed cost, or the total cost at different level is the same. So we have data for different levels. At different levels, the total cost is same. Then we get an idea that this is nothing but fixed cost. How do we identify semi-variable cost? When question specifically tells. One more hint is we calculate cost per unit. In case of variable cost, cost per unit will be constant. In case of fixed cost, total cost will be constant. In case of semi-variable cost per unit will also be varying. Total cost will also be varying. Yes, this is how we identify whether the cost is fixed cost, variable cost, or semi-variable cost. Okay. Now, to solve the questions, first, in case of variable cost, we know what is the total variable cost. First, we calculate what is the cost per unit. So for 100 units, it is 500 rupees. So it is 5 rupees per unit. Now we can calculate for any level. If you are manufacturing 1000 units, 1000 into 5, 5000. 10,000 units, 10,000 into 5, 50,000. 20,000 units, 20,000 into 5, 1 lakh. Okay. So first we calculate the cost per unit and then keep it as constant. In case of fixed cost, first we calculate what is the total cost. Then we know fixed cost on totality basis will remain constant. And for semi-variable cost, question itself will tell how to treat it. So there is no need to tell. And if nothing is given, the marginal costing assumptions, variable cost per unit, selling price per unit, and total fixed cost will remain constant. Now, blast from the past, one of the most tricky adjustments wherein everybody would generally commit an error. If question is giving us change in cost, question is telling cost structure is changing. Suppose we have variable cost, we have fixed cost. Variable cost, always we should change on per unit basis. What is the change for per unit basis? That is how we have to do. In case of fixed cost, change should always be made on totality basis. Say we have a small example here. For 1000 units, for 5000 units. For 1000 units, question is telling variable cost is 5,000 rupees. And now question is telling the variable cost will reduce by 5%. What students will generally do? They have the calculator, 5,000 minus 5% they do. Absolutely wrong. 5,000 is for 1000 units. So in case of variable cost, we change it based on per unit basis. So firstly, we tell for 1000 units, it is 5,000 rupees. So per unit, what is the variable cost existing? So we tell it is 5 rupees per unit. Now we tell. So there is a change. Question is telling variable cost has reduced by 5%. So what will be the new variable cost? Before it was 5 rupees, 5% reduction. Now it will be 4.75. So we have calculated the new variable cost. So we know for 1 unit, it is 4.75. We are producing 5,000 units. So it will be 4.75 into 5,000, 23,750. This is how it is done for variable cost. In case of fixed cost, question is telling fixed cost is 15,000. It has increased by 10%. Yes. What is the total fixed cost existing? It is 15,000. And new question is telling it is increasing by 15%. So we add 10%. This question is telling it will increase by 10%. So we add 10%. It will be 16,500. This is how, if we have a change in cost, we will be doing. Now, coming to semi-variable cost. How do we deal with semi-variable cost? Sometimes only one level of activity is given. Question is only telling at 80%, these are the costs. Semi-variable cost is 50,000. So now what do we do? Question will itself tell. When it rises from 80% to 90%, semi-variable cost will increase by 5%. When it increases from 90% to 100%, it will increase by 15%. Question will itself tell how it changes. Suppose it is telling it will increase by 10% if it is going above 75%. We add 10%. If two different levels of activity are given, question is telling at 7,500 units, the semi-variable cost is 75,000. At 8,500 units, the semi-variable cost is 80,000. We know the only change in cost will be for the variable portion of semi-variable cost, only for the variable portion of the cost. Fixed portion of cost will remain the same. So we've already discussed the formula. Variable cost per unit is change in cost, change in total. So we've already discussed the formula. Variable cost per unit is the change in total cost divided by change in units. Based on that, we get what is the variable portion of cost. We substitute, balancing figure will be the fixed portion of cost. We get the equation. Using that, whatever is the level of output, we get the semi-variable cost. Clear? So this was the first concept, flexible budget. Now we have another concept, that is budget ratios. So in budget ratios, firstly, we have the main budget ratios and additional budget ratios. What is budget ratios? They provide information about performance of an organization, whether company is performing as what they have budgeted or not, whether company is exceeding the expectations, not meeting the expectations. That is what these ratios are trying to tell in percentage form. So how do we make a decision? If it is the percentage is more than 100%, then we tell it is favorable. We are exceeding the budget. If it is less than 100%, it is unfavorable. We have not met our budget. Yes. So all in all, we have 6 budget ratios. We have bifurcated them as main budget ratios and extra additional budget ratios. Main budget ratios, we have the activity ratio, we have the capacity ratio, we have the efficiency ratio. Let us try understanding it. Yes. For a period, we thought we will be working for 10,000 hours. Yes. For in a period, we are manufacturers of pen. So for a month, we thought our employees would be working for 10,000 hours. So we'll be getting output of 10,000 hours. This is what we had budgeted. So 10,000 hours. Actually, we have worked for 15,000 hours. Okay. And by working for 15,000 hours, the output we are getting is of 12,000 hours. So we have the budgeted hours, actual hours, and standard hours. Firstly, we have the capacity ratio. We are telling how much proportion of budgeted capacity we are trying to utilize. We are telling we thought our employees will work for 10,000 hours, but in actual they work for 15,000 hours. They're trying to exceed the capacity. They're trying to go beyond the capacity. So it is favorable. How do we get it? It is actual hours divided by budgeted hours. Next, we are looking at the efficiency. We are telling no doubt our employees worked for 15,000 hours, but even though they worked for 15,000 hours, the output which we got was only of 12,000 hours. So even though they are working hard, their efficiency is not up to the mark. So how do we get it? It is standard hours divided by actual hours into 100. Thirdly, activity ratio. We want to see the overall change in activity from what we had budgeted and what we are actually getting the output. Budget, we had budgeted we'll be getting 10,000 hours output. We'll be manufacturing, suppose 1 hour per unit, we'll be manufacturing 10,000 units. This is what we had budgeted. 10,000 hours output we'll be getting. In actual, what is the output we are getting? We are getting the output of 12,000 hours. No doubt we have worked for 15,000 hours, but in 15,000 hours, the output we are getting is of 12,000 hours. So we are telling, yes, so we thought we'll be getting 10,000 hours output, but in actual, we've got 12,000 hours output. So we are reaching 120% of our budget. Yes, so we have the activity ratio overall. Yes, it is standard hours divided by budgeted hours into 100. Then we have the capacity ratio, how much proportion of capacity we are using when compared to the budgeted hours. So it is actual hours divided by budgeted hours into 100. And efficiency, how efficiently we are doing the work, it is standard hours divided by actual hours into 100. We have a relationship between the three ratios, that is activity ratio is nothing but capacity ratio into efficiency ratio. So if one of them is not available, using this formula, we can calculate them. Now we have three more additional ratios. Firstly, we have calendar ratio. We are trying to compare actual working days with budgeted working days. We are telling we had budgeted that we'll be working for 25 days, but in actual we work for 30 days. We are exceeding our expectation. That is favorable for us. So it is actual working days divided by budgeted working days into 100. Next, we have standard capacity usage ratio. We have the capacity usage ratio. We have standard capacity usage ratio and actual capacity usage ratio. I'll give you a small example. Suppose Virat Kohli, for a day, maximum he can train for 10 hours. That is what maximum he can train. After 2 days, he has got a match. So he's thinking, tomorrow, even though I can train for 10 hours, I don't want to train for 10 hours. I want some relaxation so that I'll be fresh for the game. So I'm planning tomorrow, I will just work for 5 hours. This is what he's budgeting. So we are telling, yes, he is trying to utilize, he is budgeting to utilize 50% of his capacity. Maximum he can work for 10 hours. He's planning to work for 5 hours, 50%. That is budgeted hours divided by maximum hours in budgeted period into 100. That is standard capacity usage ratio. From our maximum capacity, how much proportion of capacity we are planning to utilize. Yes, he thought he will work for 5 hours. He went there, he wanted to work on his off drive, on his cover drive. So he actually worked for 7 hours. So what is the actual capacity utilized? Maximum is 10 hours. He has actually worked for 7 hours, 70%. It is actual hours divided by maximum hours in budgeted period into 100. We get the actual capacity usage ratio. So these are the 6 budget ratios. Again, we have the main budget ratios. We have activity ratio, capacity ratio, efficiency ratio, additional budget ratios. We have the calendar ratio, standard capacity usage ratio, and actual capacity usage ratio. We have one final concept, functional budgets. One of the most important concepts from this chapter, functional budgets. So let us understand it with the help of a small example. So I and a friend of mine, we were living in a room. Yes, I was always dreaming of becoming a CA, but a friend of mine, he was doing graduation. He was not into studies at all. All time he was only thinking of drinking. Yes, he had his motto, save water, drink beer. So he was thinking, after my graduation, I should start a wine manufacturing business. So once his graduation got over, he started the business of manufacturing wine. So what is the process actually happens? Yes, he started his company. Yes, firstly, to manufacture and sell wine, he need to buy the raw material. He need to buy grapes. So first he goes to the market. Yes, he buys grapes. He purchases the raw material. He has bought 1000 kg grapes. Next, he has purchased 1000 kg grapes. Now these grapes are being consumed. Yes, to produce the wine. Yes, 700 kg of grapes is being consumed. Yes, so 700 kg grapes is being consumed, and using that, we have got 350 bottles of wine. Okay, the process, firstly, we've purchased the raw material, then we've consumed the raw material, we've produced goods. We've produced 350 bottles of wine. From that, we sell, we've sold probably 300 bottles, and from there, we make a profit. Yes, this is the actual flow which will be happening. Yes, what is the actual flow? Yes, firstly, we purchase the raw material purchase. Then from there, we consume raw material. Yes. Using raw material consumption, we produce the goods, then we sell the goods. Next, we sell the goods, we earn a profit. This is the actual flow. Now, we are planning for the next year. We are trying to prepare a budget. This year, actually, we've got a profit of 5 lakh. Budget will always start with the profit. It is the reverse of the actual flow. Now, I'm telling for the next year, I want a profit of 15 lakh. Okay. So if I want a profit of 15 lakh, how many bottles of wine should I sell? So first I prepare my sales budget. I'm telling, if I want 15 lakh profit, then I need to sell 1500 bottles of wine. Okay. Now comes the next thing. Okay, to sell the wine, to sell the goods, I need to produce the goods. So based on that, I prepare my production budget. I tell, if I need to sell 1500 bottles of wine, how many bottles of wine I should produce? I tell, I'm thinking to produce 1500 bottles of wine. But wait, last period, I had closing stock of 100 bottles of wine. So that is already there. So it need not be produced again. So if I produce 1400 only, it is sufficient. Already last year closing stock, this year opening stock, I already have 100 bottles. Extra, if I produce 1400, I'll be having 1500. This 1500 I can sell. Yes. So this is what it is trying to tell. So we've got the production budget. Next, based on the production budget, we have raw material consumption budget. So I want 15 lakh profit. For that, I have to sell 1500 bottle of wine. To sell 1500 bottle of wine, I already have 100. So I'll produce 1400 bottle of wine. To produce 1400 bottle of wine, how much grapes I have to consume in the production process? So I'm telling, for every bottle of wine, I want 2 kg grapes. So for 1400 bottles, I want 2800 kg grapes. Yes. Now I tell, okay, that is the raw material which will be consumed in production. So if I have to consume 2800 kg raw material, what will be the raw material purchase? So I'll tell 2800 kg I have to consume. 300 kg was already lying as closing stock. So 300 kg is already available. If we purchase 2500 kg, it would be sufficient. Yes. So we have the actual flow. We have the budgeted flow. Budgeted flow is the exact reverse of the actual flow. Yes, in budgeted flow, first we think what will be the profit. Based on that, we prepare a sales budget. Yes, this should be the sales. Based on sales, we prepare the production budget. If you have to sell these many goods should be produced. Based on production, we prepare a raw material consumption budget. If these many goods should be produced, so this much raw material has to be consumed. And based on raw material consumption budget, we prepare a raw material purchase budget. If these many goods has to be consumed, this should be the raw material purchase. Look at the flow: profit, sales, production, raw material consumption, raw material purchase. Exactly reverse of the actual flow. Now let us have a look at every budget one by one. Firstly, we have the sales budget. Sales budget, we get it in terms of quantity as well as rupee. It is generally already set by the marketing department. We don't have anything much to do. In sales budget, we tell, okay, in the next period, we have to sell 1,500 bottles. Every bottle will be selling at the rate 100. So this will be the sale value. So sales budget will be getting what is the unit we are estimating to sell and what is the selling price at which we will be selling. So we'll get it in terms of quantity as well as rupee. Next, we have production budget. Production budget will be in terms of quantity. It is based on the sale of finished goods. Yes. So we are preparing it to get what is the production quantity. Yes. So look at this. I'm telling next year. Yes. I'm telling. Yes. So production budget. It is based on sales. So firstly, I'll tell next year I have to sell 1,000 bottle of wine. So I'm initially thinking, let me produce 1,000 bottle of wine. But wait, I remembered at the end of the year, I want some extra closing stock. So I'm telling, even though I'm selling 1,000 units, at the end of the year, I want to maintain a closing stock of say 500 bottles. So that for the next period, if there is any immediate demand, I can fulfill that. So I'll tell, okay, to sell 1,000, I want extra 500 also, I'll manufacture and keep so that it will be lying as closing stock. So I'll tell, all in all, I'll manufacture 1,500 bottles of wine. But wait. Yes, I came to know that I'm already having opening stock of 200 bottles. So I was planning to manufacture 1,500, but I'm already having 200. So I'll tell, okay, let me reduce that. If I just manufacture 1,300, it is sufficient. So how do we get the production budget? Yes, production of finished goods, sales plus closing stock of finished goods minus opening stock. Sales plus closing stock of finished goods because we want that at the end of the year. Reduce opening stock because it is already produced and available. Yes, if you look at it in the form of the equation, this is how we prepare. Yes, we have opening stock of finished goods plus production. We already had opening stock of say 100. We produced 1,100. So already all in all 1,200 is available. From that 500 is sold. 600 is lying as closing stock. So opening stock plus production is equal to sales plus closing stock. We want to see production. So it is sales plus closing stock minus opening stock. Clear? This is production budget. Now, based on production budget, we want the raw material consumption budget. I'm telling, if I have to produce the 1,400 bottle of wine, how much kg of grapes I need to consume in the production process? Raw material consumption budget will be on quantity basis. So it is based on the production of finished goods. Yes. Suppose we are planning to produce 1,000 units. For every unit, we want 5 kg raw material. So how do we get raw material consumption? It is finished goods production into raw material per unit of finished goods. I'm telling, I want 1,000 units of finished goods, and for every finished goods, I want 5 kg grapes. So I'll be wanting 5,000 kg grapes will be the raw material consumed. Yes. Last, we have the raw material purchase budget. It will be on quantity and rupee basis. Yes. So we are telling, if we have to consume 5,000 kg raw material, how much raw material we have to buy? How do we get it? Yes. So we are telling how much raw material is required for consumption. We are telling 5,000. So we'll tell, okay, let us buy 5,000 kg raw material. But wait, yes, production people are telling at the end of the year, we want closing stock of 1,000 kg raw material. Why? So that for the next period also, we have sufficient resources. If there is lockdown or something, we have resources. So we'll tell, okay, that also we'll buy and keep. So not 5,000, let us buy 6,000. But wait, we already have an opening stock of 200 kgs. So we'll tell, okay, let's not buy that. Let us reduce that. So we want 5,000 kg for consumption, extra closing stock 1,000 we add. We already have 200, we reduce. So we'll tell 6,000 minus 200, net 5,800 kg is required in terms of quantity we got, multiplied by purchase price. For every kg, suppose it is 100, we get the raw material purchase in value 580000. Yes. So how do we get raw material purchase is nothing but raw material consumption plus closing stock of raw material minus opening stock. If you look at it in the account format, we have opening stock of raw material, purchase of raw material. From that, we have consumption plus closing and closing stock. So opening stock plus purchase is equal to consumption plus closing stock. We want the purchase. So it is consumption plus closing stock minus opening stock. Yes. So we've looked at the 4 main functional budgets: the sales budget, production budget, raw material consumption budget, raw material purchase budget. Yes. Firstly, we see what is the sales. Based on that, how many units to be produced. To produce these many units, how much raw material has to be consumed? If you have to consume so much raw material, what will be the raw material purchase? Sales and raw material purchase will be quantity as well as value. Production and raw material consumption will only be based on quantity. Sales budget will be given. How do we get production? It is sales plus closing stock minus opening stock. How do we get raw material consumption? It is units produced into raw material per unit. How do we get raw material purchase? We have raw material consumption plus closing stock minus opening stock. Note, everywhere in budget, a shortcut to remember, yes, everywhere we have stock adjustments, we will be adding closing stock, reducing opening stock. We have discussed in cost sheet chapter, everywhere we will add opening stock, reduce closing stock in cost sheet. Here, everywhere we will be adding closing stock and reducing opening stock, because this is budget. This is the opposite of actual. So we will add closing stock and reduce the opening stock. So we've looked at the main budgets. We've looked at sales budget, production budget, raw material consumption budget, raw material purchase budget. We have some extra budgets as well. Yes. Firstly, we have the wages budget. It will be available in hours as well as in rupees. So we are telling, yes, for the upcoming period to produce the goods, how much wage is required? We are telling, yes, for the next period, we are planning to produce 1,400 bottles of wine. To manufacture one bottle of wine, 2 hours of labor is required. So 2,800 hours is required. For every hour, we are paying 10 rupees. So 2,800 hours into 10 rupees, 2,80,000. So it is used to determine what is the wage payable to produce the goods or service. It is also dependent on production of finished goods. So this is how the actual flow will look. Based on sales, we have production budget. Now, based on this production, how many units we are planning to produce? To produce these goods, we want raw material consumption. We want the raw material. So we have raw material consumption budget. We also want the wages. So we have the wages budget. Next, based on raw material consumption, we have the raw material purchase budget. This is the full flow. So we'll tell what is the finished goods production. Okay. Into labor hours per unit, we get the total hours. We're telling 5,000 units we want to produce. For every unit 1 hour. So we want 5,000 hours. Into cost per labor hour, 10 rupee per labor hour, we get the labor cost, wages cost as 50,000. Next, we have expense budget. It is nothing simple. Yes, every expense we just put a total. Yes, every expense, if it is given individually, put a total. See, what is the total budgeted expense for the next year? Cash budget, we are telling what will be the cash position for the next year. How do we get it? We have opening cash balance. Yes, we add cash receipt. Whatever is the cash we are receiving, we'll add. So I'm telling I already have 10,000 rupees. Next period, I'll be receiving 1 lakh. So it will be 1,10,000. From that, I have to make a payment of 50,000. So 1,10,000 minus 50,000, I'll be having 60,000. Next, I'm planning to borrow some funds. So if I borrow, I will get the cash. I'm planning to borrow 5 lakhs. So 60,000 plus 5 lakh, 5 lakh 60,000. From that, I'm planning to invest 2 lakhs. So less 2 lakh rupees. 5 lakh 60 minus 2 lakh will be 3 lakh 60. This will be the closing balance. Clear? Yes. Next, we have a master budget. What is a master budget? Very simple. Yes. Based on all the functional budgets, we are planning to prepare a master summary budget to get all the results of budgeted period in one place. It contains all details of what is the sale, what is the raw material consumption, wages, overhead, what is the total cost, what is the profit. Yes. As simple as we are putting, this is the sales. From that, reduce all the cost. Yes, we get the gross margin, we reduce administration overhead, selling and distribution overheads, we arrive at the net margin. That is the master budget. With this, we've finished the concept of functional budgets as well. 5 important adjustments from the examination. Firstly, if we have multiple product or raw material or labor. Suppose we are manufacturing and selling pen as well as a pencil. So when we are preparing sales budget and production budget, we have to prepare for each category of finished goods. We'll be telling this will be the sales and production of pen. This will be the sales and production of pencil. Separately, we have to do. Yes. Then raw material consumption and raw material purchase budget will have to be prepared for each category of raw material. I'm telling manufacture a pen. Yes, this is the plastic purchase and consumption. This is the nib purchase and consumption. So for every category of raw material, we have to do raw material consumption and purchase budget. And the wages budget will be for every category of labor. Suppose we have skilled employees, semi-skilled employees, unskilled employees. Yes, these many hours these people have to work. This is the rate. So this will be the cost. Individually, category wise, we have to do. Yes. Next, yes, one of the beautiful questions. If sales budget is missing, the starting to make all functional budget is sales budget. Based on sales, we get production. Based on production, we get raw material consumption, raw material purchase, we get wages, everything. If sales budget itself is missing, we can't do anything. So in one question, sales budget was missing. But what happened? Desired profit, fixed cost, selling price, and sales mix was available. Question is telling, yes, desired profit, we want a profit of 5 lakh. Fixed cost will be 10 lakh. So we'll tell, okay, then contribution required would be 15 lakh. Yes. Then selling price is available. Sales mix is also available. We have two products. The proportion in which goods will be sold is also available. So how we have to solve this question? We have to ultimately get what is the selling price is available. If we get the sale quantity, we get the sale value, sales budget is available. Everything else can be solved. So how do we arrive at the sales quantity? We need to follow the concept of contribution per composite unit. Firstly, we calculate for every unit what is the contribution per unit. Okay. Then we calculate the contribution per composite unit. Already discussed in marginal costing. It is the total of contribution per unit into weight. Now we get what is the desired contribution. How much contribution we want on totality? It is nothing but fixed cost plus profit. We're telling next year we want to recover fixed cost of 10 lakh plus we also want a profit of 5 lakh. So we'll be wanting a contribution of 15 lakh. Now, how do we get the composite unit? It is nothing but desired contribution divided by contribution per composite unit. We get the number of composite units. Then the composite units be split in the ratio of sales quantity. We'll be getting the respective sales quantity. Suppose we are selling pen and pencil. We've got the respective sale quantity of pen and pencil. Selling price is available. Sales quantity is available. We get the sales value. Sales budget is available. Third, and one of the most frequently asked adjustments, if stock figures are missing in production budget, then what do we do? Yes, there can be two different type of questions. Either first month opening stock is missing or else last month closing stock is missing. So first month opening stock is missing. Just have a look at the small data. Question is telling production is 80% sales of the month plus 20% sales of the next month. Question has given us what is the sales. Question has given us closing stock of 1 month. Yes. Now see, we are producing for 20% sale of next month also, which will be held as closing stock. So closing stock is available in first period closing stock. I'm telling I will produce 20% of sale of next month also. That is 20% of 40,000 will be 8,000. Here I will produce 20% of 60,000. That is 12,000. I will produce in this period and keep. Okay, 6,000 anyways for the last period closing stock will be available. Now sales plus closing stock minus opening stock will be arriving at production. Now how do we get the opening stock? Firstly, for both these periods, yes, closing stock of one period will be the opening stock of next period. So closing stock here will be opening stock here. Closing stock here will be opening stock here. But opening stock of first period is missing. So how do we get it? We can get it as closing stock of the last period will be opening stock of the first period. Yes, last year whatever was the closing stock will be the opening stock here. And what will be the closing stock last year? We know closing stock is 20% sales of next month. That is, so closing stock would be 20% of 50,000. That it would be 10,000. Yes, this is how we arrive at the opening stock of finished goods. This was logical. One more way to look at it is every month we try establishing a relationship between opening stock and sales. So opening stock is 8,000, sales is 40,000, it is 20%. Here also 12,000, 60,000, it is 20%. Yes, so we'll be telling here also it will be 20% of the sales. So 20% of 50,000 will be 10,000. Clear? So if first month opening stock is missing, what is the steps we'll be following? Firstly, we try establishing a relationship between opening stock and sales of the month. Next, once the ratio is available, we got opening stock is 20% of sales. That ratio is used on sales of the first month to arrive at opening stock. Clear? Next, if last month closing stock is missing, but total production data is available. Quarter wise, for every period, sales is available. Yes, for the year as a whole, total sales is available, total production is available. Opening stock everywhere is available, closing stock for all months is available. But the end of the year, closing stock is missing. What do we do? For the entire year, use the equation of production to get the closing stock. Yes, suppose question is telling here, on totality basis, we are selling 1,50,000 units. Okay. For the year as a whole, we know what is the production. Question is telling we'll be producing 2 lakh units. This data will be given. Now, for the year, opening stock at the start of the year was 10,000. We don't know what the closing stock will be. Yes, we can get the closing stock as a balancing figure. So it is 1,50,000 plus if it is 60,000, 2,10,000 minus 10,000 will be 2 lakh. Yes, so what do we do? For the period as a whole, sales plus closing stock minus opening stock, we get the production. Sales is available, opening stock is available, production is available. We'll be getting the value of closing stock as well. So these are few adjustments wherein ICAI may try to trick you. So have a look at these on the day before examinations. With this, we've finished the chapter Budgetary Control. We have so many resources to help you ace your preparation for the last day. Let me just tell it out to you guys. Firstly, we have the costing marathon revision wherein we have covered the entire costing in just 6 hours. We also have a top 100 practical questions for the last day. We have shared a PDF file containing top 100 practical questions which students need to see on the day before exams. We also have a PDF theory question booklet which contains all the necessary theory questions. We also have a WhatsApp group for doubts so that whoever is having doubts for the one day before examination, you guys can ping me and I'll be there real time to help you guys. Link for the groups and resources is already given in the description. Oof, that was one hell of an experience. Yes, so we've taken slightly more than 2 hours, but I feel it was all worth it. Yes, students. So these are the 5 most important chapters and we have revised them in the best way possible. With this, we have reached to the end of costing marathon. I've recorded the classes with so much dedication and love for you guys. I had throat infection, cold, but still I went on to record. So tell us in the comment section how the video was. If the video was useful, share it to your friends and drop a message in the comment section telling how useful this video was. It really motivates me to work harder and bring more amazing videos for you guys. Remember, you are the hero of your story. A hero will go through some rough patches, some difficulties, some struggles, but ultimately, these struggles itself will make it worth the journey. You are the hero and you are here to win. Give your best for yourself, for the people who believed in you. Give your best. And for the people who said it is not possible, work even harder. Show them your CA material. Show them you're here meant to be a CA. All the very best students. I'm sure you'll all rock your exams. And once you clear the exams, don't forget to inform me. I would be happiest to know our students have cleared the examinations. All the very best rock stars. Study hard, party even harder. See you soon. Bye.